All right, everyone in the class, I hope we are live and I hope we are all set with the audio video. So, everyone, welcome to this amazing session. Very good morning. Please tell me if you can very properly see me, hear me, or not. Come on, all the live people, welcome to the session. All the recorded people, welcome to this amazing session on CA Final AFM, the most important four theory topics of this subject. Come on. Who all do I have in the class live today? Very good morning. Please mark your presence. Recorded people, come on. Sir, we are going to cover four important theory chapters, that too in full English language. One is a startup finance, then is securitization, third is financial policy, corporate strategy, and then is risk management. We are going to cover each and every topic from each and every topic of these four chapters, meaning to say your coverage for these four chapters will be 100%. Sir, why only these four particular chapters? Let me show you all an analysis. For example, just hold on for a second. I hope the analysis is there with me somewhere. Hold on for a second. I mean, I will have to open it once. But you've observed the past exam analysis of theory chapters. I'll soon share it on the Telegram channel. You will realize that out of 4 to 5 theory questions that institute ask for around of 4 marks each, right? On an average. 3 to 4 questions, which means out of 4 to 5 questions, 3 to 4 questions of 4 marks each belong to these 4 theory chapters. Let me share my screen and then speak up. Just hold on for a second. Let me share my screen and then speak up. So as I said, out of 4 to 5 theory questions that institute ask in every year, to use a theory file which updated for Jain 26 is available for you people on the Telegram channel, the link for which will be given below, right? This file has compilation. So this was the file I was talking about. For September 25, I'm yet to update it. For September 25, I'm yet to update. I'll update it, the marking scheme, and then we'll show you. So you'll observe that the theory asked from these 4 chapters, in which the first priority chapter is startup finance, then is securitization, then financial policy, corporate strategy, and then risk management. The theory of these 4 chapters is primarily asked, as I was saying, for more marks as compared to theory for other chapters like derivatives, security analysis, forex, equity business valuation, etc, etc. Does that mean we should not cover the theory from those chapters? If the time allows, cover it. But if you talk about the smart studying, the efforts it will take to cover up those theories will be too much, and the probability of they asking the question is relatively lesser. Sir, is it a guarantee that in our attempt the theory will be asked from these particular questions? Let me tell you. Institute sometimes does happen that ask very limited theory question. Even these have been the cases. For example, in November 24, only 4 to 8 marks theory have been asked out of 118 or whatever that number is marks paper. Correct? Now 114 marks or whatever. Cool. Sir, 116 marks in fact. Sir, sometimes they ask you proper theory. For example, in May 25 they just ask, in September 25 they did ask, right? Now, majority the theory is being asked from these chapters, but it happens sometimes like this attempt of November 22 where theory from other than these 4 chapters was primarily being asked, right? So it may be a case, but that is a one-off case. As you can observe in the past attempt, it was a very limited time where theory from all other chapters collectively was being asked. Yes, so we have Yatin is here, Ujjwal is here, Vidya is here, other live people sitting in the class. Come on, very good morning. Now, sir, this file, first of all, is a very reliable source for you to go to the theory. Go for the, very reliable source for you to refer for theory topics. Sir, why? Starting with the first reason, sir. The base for this material is a study material, which means the place from where the content of this has been taken is from study material. Even if I find that content to be not very relevant or maybe insufficient, I have taken that content as it is, because when it comes to marks, you will get marks only when you write what's there in the study material. So which is why the same has been incorporated in this book. First. Second, sir, the institute's material is really comprehensive. Sometime where a line is to be written, they end up writing the entire paragraph. So I have taken out those particular pointers which are enough for you to write down in the exam by eliminating unnecessary stuff or text so that you don't have to waste time to read the entire thing. Third, all those theory have been better presented in terms of better headings and understanding. For example, this particular thing in first chapter, which is financial policy corporate strategy, you have to explain the different levels for hierarchy, right, of strategy. So these are the three levels. Now when you read something which is in terms of some colors, some diagrams with better heading, it is easy for you to understand as well as remember it, that okay, I remember there were 3 points, there were 3 levels of it. Yes. So a better presentation, for example, this small understanding of how the corporate strategy and financial policy related to each other. Now when you face a question in the exam, this a small diagram might help you to think that okay, this is the particular topic, or for this particular thing. These small colorful charts help you to remember the thing, make the book look more interesting and colorful than the boring study material. Fine. Last and very important, we don't believe in approach of question and answer, that I give you a question, you do the answer. No. I want to make see, when I ask you a question, you create a box in your brain that okay, this is the question, this is the answer. You don't end up thinking, people in the class, it's really important to understand, you don't end up thinking that to answer this question, what are the possible questions institute may ask? To have this answer, to write this answer, what are the possible questions? So when I don't follow a question answer based approach, your brain remains open, that's not closed in the box, and you can then think freely of what are the possible questions for which this answer can fit. Having said that, knowing the questions is also important, that what kind of questions institute may ask. So all such questions from RTP, MTP exam papers have been compiled before every topic. For example, if this is the answer, right? First of all, you should more importantly focus on the heading when it comes to any theory topic. Guys, listen to me very carefully. When it comes to any theory topic, reading the heading is important, because primarily from this heading question will be asked. Second, possibility of question is from any particular line in the answer. Two primary ways institute can create the question. First, from the heading. Second, any particular line in the question, right? And that's why I'm saying it's important to go through the headings also. Now, these questions are there for you to understand that okay, for these questions this was the answer. So if any such question come to the exam as it is, you are capable of answer it, and by reading these questions you can get a sense of what kind of questions I can expect in the exam, so that you are not directly facing them for the first time in the exam. Yes. So these were certain basics I wanted to discuss with you all. As I said, the first chapter we're gonna cover is the start of finance. So everyone, shall we all get started? Come on, please tell me. Shall we all get started? So we have said deep. What's your full name? Someone called as said deep. I'm not able to understand what's your name is, but very good morning to you too. Come on. Shall we all proceed? Yes, people? To start with the first chapter, which is a start of finance, the most important theory chapter of the entire curriculum. Perfect. Yes, so before we get started, to get the best out of this video, you must first of all like this video and subscribe the channel so that I get that enough motivation to create more such videos for all of you people which can help you in the exam hall, which will help you for your exams. Perfect. So everyone, startup finance. The first question is, what are the innovative ways of financing? So please observe, the heading is innovative ways of financing, but institutes sometime end up asking up the question, which is sources of funding a startup. Fine. Because ultimately funding a startup and financing a startup is more or less the same. Anjali, very good morning. All other live people sitting in the class, very good morning. Say something in the chat box so that I can know that you're present in the class. Everyone. Sir, first source is personal financing, which means when I start a business, I have to invest my own money. So investing your own money is personal financing. And please understand, no outside party, no investor, no relative will put their money unless we put our own money in the business. So they will not put their money. Sir, what should be the approach? The last important thing. You must have heard certain people on the YouTube saying that only remember the headings. The text in that heading is not important. That's not true. At least the primary keywords, right? The main context, you should always try to write the way they are written in the study material. So I've tried to, highlight those words by underlining them, right? So that you end up writing the same thing in the exam. So not only the heading, but the broad context. For example, personal financing, if I don't write the content of the book, there are a number of things for me to write. I can define what personal finance is. I can I can give the examples of personal finance. But in the study material, do you observe they have not given any example? They have rather given a particular line that investor will not put their money if they don't see any personal source of money already invested. If you don't write that line, I feel it become difficult for examiner to give you marks. You may end up writing them at your own, which is fine. But the context, overall meaning of the paragraph that you write down should be this, is what I believe. Language can be your own. In case of headings, they should be as it is without any scope of modification. Yes, perfect, cool. Sushmita and Hemu says kindly take fixed income securities. I'll take it. Okay, so let's first complete this one. Sir, first is personal financing, then is personal credit lines. Me at an individual level can also take credit from the bank. I can take a personal loan, I can make use of a credit card. So using that credit, personal credit line money in the business can also be a source of finance. Sir, one's personal credit effort can be a source of finance, but banks are really cautious while giving that personal credit lines because the business should have the capability to repay the credit. Sir, next is family and friends. The closest people you trust, who will trust you, are the one who will be ready to give you money. So they might give you sometimes out of affection without even thinking if your idea is going to work or not, right? But make sure the loan that you take from your friends and family are written down as a promissory note. Now again my point, if they don't, if you naturally read friends and family, and if I ask you to write down at your own, you will never end up writing this particular line that the loan should be written as a promissory note, right? But if you think that, okay, I will write the heading and don't write this particular line in the exam hall, then I don't think institute is going to give you marks. So please always remember the broad context in the exam hall that you write down should be around the text which is already there in the study material in your own language. But you cannot write down any random thing, even relevant to the topic, if it is not there in the study material. Perfect. So that was the main crux. I've given an example of it. Moving ahead. Sir, friends, family, they are the source because they give you money, even because they trust you, even without figuring out if the idea will work or not. The loan obligation should be written down as a promissory note. Okay, there should be a contractual agreement that, okay, I've taken this money from you and I promise to pay it back to you. Fine. Crowdfunding. Sir, There are websites where a small individuals, a crowd of people in the public in general, 10 can fund a startup. They collectively accumulate amount and that amount is then used to fund a startup. So a small amount of capital from large number of individual to finance a new business. Sir, these are the websites who bring entrepreneurs and the investors together. One side of the website is people who want to take money, entrepreneurs. Another side of the websites are the investor who want to invest on this startups, and this platform, the websites, pool the money and then invest in the web startups, entrepreneurs, called as crowdfunding, then microloans. There are some individuals or group of individuals who are ready to give loan at a lower rate of interest to the business venture. Sir, there can be a single individual giving that loan or the group of individual collectively giving the loan to the business are micro loans. The word micro because the loan amount is really small and that is at a lower rate of interest. I'll try to link the heading with the word in the paragraph so that you can connect. Sir, peer-to-peer lending. Sometimes a group of business in the same industry who are peers among themselves, they try to promote their business. So if someone new enters in the market, they collectively give loan to the new enterprise for them to settle in the business. So peer-to-peer lending involves group of people who come together and lend money to each other. Sometime I need money, you all lend to me. Sometime you need money, we all will lend to you. So this peer-to-peer lending is another source where small business groups having similar interest generally support each other is peer-to-peer lending. Yes, vendor financing. Sir, I am a company, right? I want to purchase something. So from the vendor, I will approach the vendor that first of all, you finance me, you give me money. The same finance I will use to purchase your product only so that I can sell it further in the market. Sir, vendor financing is the form of financing in which company lends money to its customers so that it can buy the product from the company itself. Are you understanding? Now, when the goods are sold, I will receive the money and then I will make the payment to you. So until then, the payment is deferred, right? So this depends on the one's credit worthiness. If my credit ratings or credit worthiness is good, then only the vendor financing will work. Then is factoring. You know what the factoring is. I can sell the goods on credit. Whatever is receivable to me, those receivables I can go to the factory, sell it off. You have learned it at CA inter level. Yes. So Nishi, it's really important for Jain 26. In fact, this theory is important for all the attempts because so far what has been the observation institute primarily asked theory from these chapters. Account receivable factoring, when you sold those receivable to a finance company, the finance company give you the amount against the sale of debtor today itself. This is a source of finance to me. So when you sell the goods on credit, the amount against that is received by selling it to the company. Purchase order financing. Suppose I want to sell something for which I need to first manufacture it. So my customer whom I am going to sell is going to directly pay to the vendor from whom I will purchase. Purchase order financing means my customer will directly pay to the vendor from whom I will purchase. So once the payment is made, once the advance reaches there, I will receive the goods, I will manufacture it, processes and then sell it to the customer. Startups are not able to find new orders because they don't have necessary cash to produce and deliver. Right? Where is the problem? Because I don't have the necessary cash to first of all produce. For I need capital, produce and then sell it. So purchase order financing companies often advance the required fund directly to the supplier. It allows transaction to complete and the profit flow to the new business. Amount of profit remains with me. Extra cost has already been transferred there. I mean the initial cost has been transferred there. These are primarily the innovative or the sources of funding a startup. In the exam, you don't have to write down all 9 of them. Maximum 6 to 7 of them you will have to write down. At point it happens that institute might give you 3 particular names which you will have to write. So don't think that you will end up remembering only 7 of them. You cannot leave any 2. It may ask you to give specific names that write down a short note on these 5 particular points that how are they the sources of funding the startup. Getting it, people? Cool. Next is modes of financing a startup. Guys, what are the modes? So please understand, you have to particularly remember, when they sources, these are the sources. When they say innovative ways of financing, this is it. But when they say mode of financing, although the language is more or less the same, but in case of mode, you will have to particularly write down these things. First mode is angel investor, then is venture capital fund, then is bootstrapping. These are officially the ways to finance the startup at a relatively advanced level. This was very initial, extremely initial level of financing in small amount, where an individual at its level try to arrange for money. Now are the modes. First are angel investor. So there are some rich people in the market. For example, some let's the example of who's this founder of boat, Apan Gupta. He's also CA, right? So for example, he has now become an angel investor because they are the affluent, very capable, highly rich individuals who can inject capital in the business, at least at the initial level, right? They help the business to propel or ongoing injection of money. Either they help the company to initially grow, or if the company is already there, they help it to grow faster, or meet the existing need of the business. So they help the startup at their first steps. At a very initial step, while the amount required is relatively lower, they help the startup. They invest their own money. Since they are rich enough, they invest their own money in the business, and sir, they are usually the individuals. Although they are called as angel funders, private investors, seed investor, business angels, right, informal investors, but they are usually individual. But the way they apply money is through an entity. They don't personally invest it. They have a LLP or a trust or something created. Through that entity, they route the money and invest in the startup. They are the angel investors. They are individuals, right? Second is venture capital fund. Can you please imagine a mutual fund where a lot of people like you and me, where a lot of financial institutions like banks, mutual fund, insurance company accumulate their money in the mutual fund, pool their money in the mutual fund, and then mutual fund invest it into the different securities like stock, bonds, etc. Similarly is venture capital fund. HNIs, the banks, the financial institutions, the insurance companies, all of them accumulate their money called as venture capital fund. Why do they accumulate money? With an objective to invest in different startups. So venture capital is the money provided by professionals, the fund managers, venture capital fund managers, who invest in young and rapidly growing companies that have a potential to develop significant economic contribution. They develop into a significant economic contributor. Simply, they can become a huge company, right? In those growing companies, professional invest their money. So that is a venture capital. Venture capital means the amount of money, the capital provided to those companies, venture capital. Now, what is venture capital fund? Is the investment vehicle, is that pooling vehicle, is that intermediary that manage the fund of the investor. Who are the investor? HNIs, banks, insurance companies, for who are seeking to invest in the startup and small business with exceptional growth. Venture capital invest in the equity and debt securities of those startup business. Correct. Venture capital fund generally invest in new and rapidly growing company, purchase equity security, assist in the development of new product and services. Not that we give them money. Beyond that is some role like helping them to develop that goods or service, right, and adding the value through to the company through active participation. Sir, what are these two things? I will help you with these 2 points further when we go ahead in the advantages of venture capital fund. Yes. So everyone in the class, who are the investors in the venture capital fund? Financial institution, bank, pension funds, HNIs, etc. I would want you all to please wait for a second, pause for a second, and give me a understanding, the live people especially, or maybe also the recorded people, guys. Please do comment down. The way we are learning the things, is the approach comfortable? Because with the similar approach, we have to go ahead and cover all 4 chapters. So are you people comfortable with the language, with the speed, with the way we are understanding the things? Please tell me. Come on, come on, come on. Waiting for your response before I go ahead. You will have to particularly respond to this. Are you people understanding the way we are learning? The approach, the speed, the language, everything. Is it clear? Vidya says yes. Come on, all the live and other recorded people. All set? All done? Can we all go ahead with this? Yes, so come on. Next is bootstrapping. So when it comes to the modes of financing the startup, it is officially the mode. The first feeble one was angel investor, then is venture capital, and then is bootstrapping. There is a high probability that institute will not ask you this question broadly, what are the modes of financing. They will rather ask you, write down the short note on angel investor or venture capital fund or bootstrapping. So bootstrapping word is actually, not taking any external help within yourself, with your own money, with your own finance, managing the money within the company and surviving and growing the company. Sir, it is building a company from the personal finance or from the operating revenue of the company without any external help, without raising any external money. Zerodha, the company Zerodha is one such example which has grown significantly without any external funding. So method in which a startup can bootstrap is trade credit is the first thing. You buy the goods and services on credit is the first way, because that is a source of finance where you don't have to dilute equity, you don't have to raise money from equity and debt to get money. Trade credit is, you know the meaning of trade credit. You don't have to define what a trade credit is, right? But you have to please realize, when you're a new company, go to another company to buy something on credit, they will be reluctant to give you. So you should have a well crafted financial plan to convince the supplier about the need of the trade credit. And how can you make money by selling your products from that? How can you make money, right? Once they give you the trade credit, you will manufacture and sell the product, you will make money and repurchase from them is a kind of plan you will have to prepare. If a small business, if the business is really small, you can directly approach the CFO of a company. Correct. So as I said, the language can be your own, but the broad context of writing the point should be this much. Sir, along with the financial plan, you should explain to them about the business model. It is not only about the finance. Ultimately, it is the business which will be turned into finance. Correct. So you should also be able to explain about the business, about your plans and importance. Why is it important to get the first order? Right? And how will their trade credit help you to get that first order? Actually, in the study material, this was not pointers, these were all paragraphs, but writing them down in points help you to remember them, that what exactly was the content. So in the examiner, if you have been asked the methods to bootstrap, write them down in terms of paragraph only. There will be 3 paragraphs, basically one heading, one paragraph, another heading, another paragraph, third heading, third paragraph. That's all I'm saying. Cool. Next, everyone, is factoring. You know what the factoring is. Sir, factoring is a method where accounting receivable is sold to the commercial finance company to raise capital. I've sold something on credit, my amount is blocked, I have debtor in my book, I can sell those debtor, realize the money immediately. Obviously, by deducting some amount. Cool. It frees up the money that would otherwise be tied up. It also reduces the cost related to maintaining the account receivable. The debtor which would be otherwise there in my books, I will have a headache of maintaining them, reminding them for the payment, they giving me money, they defaulting. All that process can be eliminated by, factoring the accounting receivable. So as a startup, when I have limited staff, I don't have time or the energy or the resources to manage all this thing. Factoring can really help. Third is leasing. When it comes to, setting a manufacturing unit or plant, I might have to purchase some equipments, machines. So rather than buying them, I can take them on lease, so that the initial capital requirement is not there. So it reduces the amount of capital employed in the business and both the parties can enjoy. Sir, as a lessor, I have to pay the lease every year, which is an expense on which I will enjoy the tax benefit, right? I am a lessee, and the lessor, the party who has given the asset on lease, continue to own the asset, and he can charge the depreciation in his books. He will also get the tax benefit. Sir, that's how the leasing can help both the parties. So that's how there are 3 total methods. Factoring and leasing involves, so first, this factoring, if you observe, this involves explaining what factoring is, right? Leasing involves explaining what leasing is an advantage. So try to understand what that topic is trying to say. Joy, very good morning. Everyone in the class, again, very good morning. Try to understand what this topic is trying to say. This is trying to explain leasing, and then is the advantage of leasing. This is trying to explain, this is trying to explain factoring and then the advantages. Similarly, trying to explain leasing and then the advantages. Similarly, trade credit has not been explained. Unfortunately, trade credit has not been explained. They have rather directly specified where is the problem in trade credit and how do we solve that problem of trade credit. That's how the topic of bootstrapping is, which is why I sometimes find the theory to be hard to cover. If they follow a standard approach, for example, even in the trade credit, first they explain what the trade credit is and then its advantage, it will be easy for my brain to remember because things have been there in a specific format. Because unfortunately, I don't have a freedom of writing down anything in the exam, right? Even if it is correct, but if it doesn't match with the institute material, you won't get marks. Which means there has to have some element of remembrance. In this video, you will really understand things, you will be able to remember it to an extent, but ultimately your revisions will make your remembrance more strong. So unfortunately, institutes, text is not very well designed or very well organized or very well curated to make the things look organized and standard. Unfortunately, right? That was the modes of financing the business. The next topic is really interesting: pitch presentation and its approach. All of you have seen Shark Tank, where the businesses come to present, where the individuals, the founders come to present their business. We will talk about it. Just give me a second, let me have water, then we continue. Yes. Cool. Sir, pitch presentation. As a founder, when you will go to those angel investor, those venture capitalists, you will have to present yourself, you will have to present your business, your ideas, everything. What all should that pitch presentation include? So pitch presentation is a short and brief presentation of investor explaining about the prospects of the company. Why should the venture capitalist, or why should the angel investor invest in the startup? Write a quick overview of the business plan. What should the approach be? First of all, introduce yourself, because once you introduce yourself, when you explain about yourself, it creates an impact on the mind of the investor, right? Once the investors are interested in you as a person, then they'll be interested in the business. Sir, the team, the next thing is to introduce your team. This is how it happens even in the Shark Tank, right? The founder in introduces himself and then he introduces its team, because it is not only you who will make the business successful, but also the team who will ultimately going to make the product and service successful. Then explain the problem. What is the problem you have identified in the market which prevails, right? Which you are going to solve. Explain that problem and then explain the solution, that okay, this is the solution through which we will solve the problem, and through this solution how will we make the money. For example, you see that there is a problem that someone is sitting at its home, he want to have food but he doesn't want to go out. This is the problem. What is the solution is that you have created an app called as Zomato, Swiggy, where you can order the food from the app directly. So this is the solution you will offer. Now you will have to explain the marketing and sales, meaning to say, sir, unless you know how big the market is, for example, if you are targeting a particular thing, like for example selling the products, any kind of product to the entire India, imagine Amazon, the market size is different, and selling the lectures only to CA student, the market size is limited. So market size is really important to be communicated. This is why I'm specifically focusing on, because the heading says something else and the text in it says something else. When they say marketing sales, what I primarily think of, what will be my sales strategy, right? But along with writing that down, right, you will have to first explain, tell them the market size. So include this line in your answer that market size is really important to be communicated, and the marketing strategy to grab that market is also important. Sir, the projections and the milestone. When you do this business, when you solve the problem, you generate revenue, you make money. So what are the milestones and what are the projections about the milestone you are going to achieve? So projected financial statement gives you a brief idea. Projected financial instrument and statement include income statement, balance sheet, cash flow, the three basic financial statements. Perfect the competition. Not that you are the only one doing this business, there may be other people, and even if you are unique, there would be some existing competitor. For example, if you feel that Zomato is the first one to enter into the industry, then there are offline setups which are anyways available where you can go and eat. So they are your competitors. You have to explain them that even if you are new, what is something that is different in you as compared to your competitors, which gives you an edge. Perfect. So even if your product is new and unique, it is necessary to highlight how are you different than his business model. Business model is a very wide terminology. It includes everything. Business model includes the aspects of your business, operational process, what all will you offer, who are going to be the target customers, what is going to be our strategy, what will be the infrastructures that you need to do that, to execute that business. You will need an office, a setup, or a factory, or a manufacturing plant. What is going to be the operational structure, who's going to be the head, what are going to be the divisions. So the business model is a very broad term which includes everything. So we need to explain to them the entire business model, people, and then is financing. If there have been any previous financing, explain to them about it, right? If the money already raised, tell them how was that invested and what was achieved. If no money has been raised, explanation that how much work has been done at your own level, and with the new money, what are the plans. The need of financing is to be explained. This is what you should include in a pitch presentation, people in the class. The examiner can ask you the questions in this format, which you already see here. Next is document for financial projection. When it comes to projecting the milestones, what are the documents you require? No one better than you as a CA student can answer this question, people. Please try to guess. They are saying present income statement, cash flow, and balance sheet. Simply write down what these statements tell you. Cash flow tells you, right, the income and expense which you project, sales, cost of goods, other expense. It ultimately tells you the profit your business will be able to make. The monthly income statement or the quarterly or annual income statement can be made. Then cash flow statement, it specifically tells you about the inflows and outflows. It helps you to understand the cash position, the liquidity position of the company, right, which is really important, right? How much cash will be coming and going out. It helps you to understand the equity position. It can also be monthly, quarterly, annual. Then the balance sheet, it tells you the overall financial position, what are the assets of the companies, the liabilities of the company, or how those assets are funded through liability, in the debt, through equity. All that a balance sheet tells you. The financial projection is also important. The annual is fine. So these two projections, quarterly, monthly, annual, the balance sheet is annual, generally fine. Sir, next is venture capital financing. You remember a mutual fund kind of structure. When you do that financing, what are the characteristics? I am a venture capital fund. I will invest in different startups. When I do this investment, what are my characteristics? The perspective, the understanding, the background is really important before directly jumping to the solution. As a venture capital fund, when I invest, I know that my investment is for a longer horizon. Because investing in another company which is matured enough, like TCS, Tata, TCS, or any other brand of Reliance, Tata, any other bank, a matured company investment is fine. I can get an exit whenever I want, even after 2 months. But when I make an investment in the startup, I cannot plan to take out money after 2 months. I will have to give time to startups to do business, grow, get a higher valuation, and then only I'll be able to sell my stake to someone else. So investment is generally from 3 years to, it can also be for 10 years. That longer time horizon is there in the mindset for a VC to invest in a startup. So lack of liquidity. The shares in which I am investing is, first of all, not listed on the stock exchange. Second, the nature of business is risky. So when I buy those shares, when I invest in that startup, I won't be able to easily find a buyer when I become a seller. Later on, I want to sell it. I won't be able to easily find a buyer to my company because shares are unlisted. The business is risky. The amount involved is huge. The liquidity is relatively lesser, which is not a problem to me. Since the liquidity is relatively lesser, sir, I charge a premium for this liquidity, similar to how I have risk premium. I told you in the practical part, required rate of return includes the notional risk-free rate plus the risk premium. So there's one more element called as liquidity premium, correct? Which involves a higher required rate of return because of the liquidity risk that you take. So that's incorporated in the required rate of return. So long as you are getting that return, you don't have a problem. It is a high risky business. So you're not investing in a matured company or investing in the companies which are in the process of growing up. So the risk is really high, but as a VC, you're prepared for it. You take that risk because you want to earn a higher return. So long as you are earning a return, you are being rewarded commensurately for that return, it is worth to take that risk. Sir, the participation generally is in the form of equity, because when you buy the equity share, you become the owner of the company. You can help in the company in its management. You can participate in the management of the company, not only as giving the as become the capital provider of the company. These are the characteristics of VC financing. Now the advantages, sir. Now think from the perspective of a startup. As a startup, when I got money from VC financing, see, this was from the perspective of venture capital, that when you invest, what is the mindset? When you look at the advantage from the perspective of startup, when you take money from them in the form of equity, equity is the most stable form of capital which comes to the company without any underlying risk, right? There's no foundation to pay any interest or dividend. So it provides a solid capital base to the company, and that too without risk. People, when someone give you money as equity, they become your business partner. They participate in risk as well as the reward, right? So they are same, or they are at par with you. The venture capitalists provide practical advice and assistance. The VC has a business of investing in the different company or one such company. So based on their experience of investment into different companies, they can actually give you some kind of practical assistance or guidance. Next is, venture capital has network of contacts in many areas, right? So me as a VC have already contacts of investing in different companies, their vendors and so on. So when that is the case, I can help you out, help a particular company in anything, because I have those networks which can help you, sir. Then provide additional round of funding. It is not a one-time investment that I've made. Later on, after a year, you need more money, you can raise more money through further round. So that is the facility that is available with the venture capitalists. That is an advantage that company has. And the company also has an advantage that the VC will prepare the company for IPO. Recently, I've observed that the entire market in the past 1 year was dominated by IPOs of primarily startups, right? For example, a lot of company like say Lenskart or all such companies like Nisho, like various companies have come up with the IPOs, right? So the VC also prepare the company for the IPO, freeing the capital of the VC as well as the promoter. This is the advantage of bringing VC into the company. Boss, again at this point I would need your validation. Are you all aligned, understanding what is being spoken? Are you please settled? Come on, tell me. Come on, tell me. Quick. Super fast, super fast. Initial chapter at multiple steps, I would need your validation. Please tell me. Structure of VC in India. This one is really logical to understand, and once you understand it, it's easy to remember. It's really easy to remember. Sir, two types of structure primarily: domestic funds and offshore fund. In the offshore fund, then there are two further structures, which is offshore structure and unified structure. Domestic fund, really easy. The people who want to invest in the startups are Indian domestic. Perfect. The aggregator, the intermediary or the venture capitalist fund, right, who pools the money, that is also Indian. Listen to us. Everything is India. The people who want to invest money are Indian. The company who is responsible for pooling the money is Indian. That pooled company, the pooling vehicle does not invest directly. Even in the mutual fund, how does it practically happen? There are two companies involved. There is this particular company who pools the money. It passes on the money to another company who is called as asset manager, who has professionals sitting there, the CAs, CFAs, MBAs in finance, who invest money in the different startups. I mean, as a CA, if you get to work in a VC, I think that is one of the most interesting, highly paying, rewarding job that you can have practically in the world today. Perfect. So this is the amount people in the class. So one is pooling vehicle, another is asset management company. This is India, this is India, this is domestic one. Another possibility, offshore structure, where what happens? Sir, offshore, so let me read it. A domestic vehicle for pulling the money from the fund from the investor is there. A separate investment vehicle, which is the asset management company, which is also Indian, does the job of investing the money. Sir, the entity for pulling vehicles falls between a trust or a company. Sir, the LLP right now in India is not recognized. When you talk about this pooling vehicle, what can be the nature of this entity? Can it be a private company, public company, trust, partnership? What can it be? Sir, this company can be a trust, this entity can be a trust and a company. Partnership, the limited partnership as of now is not allowed in India. However, it is allowed outside India. This asset managed company, nothing in this context have been spoken in the book. Sir, next is offshore structure. Under this structure, offshore investment vehicle, right, which is a limited liability partnership or a limited liability company registered outside India, make the investment directly in the portfolio of Indian companies. The asset managed by the offshore manager, while the investment advisor in India carries the due diligence and identify the fund. Let me tell you, this is an outside company, foreign company, this is a foreign company. So there is this foreign company who pools the money of the foreign investor. This is a foreign company which receives the pooled money from the trust or from the pooling vehicle. This asset management company is also a foreign company, which then directly invest into India. For example, Indian startups like Paytm or Meesho or any random startup, Upstocks Grow. In these startups, these foreign company will invest directly from there. But again, who will help them? There are advisors in India who carries out the due diligence, identifies deal for them, that what can be the next project in which they can invest and so on. Next is unified structure. The unified structure is really easy. There is this pooling vehicle who, in which the outside India investor invests, the foreign investor. That pooling vehicle invest in Indian pooling vehicle, in which Indian investor will also invest. So Indian pooling vehicle has the money from the outside pooling vehicle as well as the money from the Indian investor directly, who will then give money to the asset management company, who will then invest in the startups or the companies. The overseas investor pool their asset in the offshore vehicle. The overseas investor pool their money in the offshore, which means when they say offshore, what do you mean? Offshore means foreign. Offshore is an alternative word for foreign. Foreign vehicle, right, that invest, it's basically an overseas vehicle that invest in the locally managed trust. When we say locally managed trust, it means the locally managed pooling vehicle. Sometimes it does happen that you understand the thing really well, but when you read the text, you're not able to connect your understanding to the text. So my objective in this video is to make that connection, which is why despite explaining something to you really well, I am going through the text so that you have that comfort. So overseas investor pool collect their money in their asset in an offshore, which means foreign vehicle. The pooling vehicle, that trust which collects the money, is a foreign vehicle that invest in a locally managed trust. One second. Huh. Then invest in a locally managed trust. Locally means Indian. When they say locally managed trust, India managed trust, so they will invest in Indian trust. where domestic investor will directly contribute to the Indian trust, right? This trust make investment in the local portfolio investment with the help of asset manager. This Indian trust will give money to the Indian asset management company, which will then manage the portfolio, which will then invest in different companies. That is how a unified structure is. This is a type of structure the VC can have in India. So ultimately, please observe that the company being invested is an Indian company. The source of money here is India. The source of money here is foreign. The source of money here is foreign as well as India, which is why called as unified structure. I hope I'm able to convey this to you all. Perfect. Sir, stage of venture capital financing. At what stage the financing can happen? Sir, at various stage. Depending upon how, in how initial, at what level of initialness is the has the investment happened to how mature the company became, there are different stages. Seed money is extremely initial level investment, which is why the period of investment is longer, even 7 to 10 years, where the risk is extremely high. The purpose of financing is too early, that you are trying to figure out through that fund if the idea or concept will work or not. You have to first of all do the research and development for product, and involves very little amount of financing, because that is just to do the research of whether this product will work or not, whether this product can be created or not. That research phase. Then startup phase, where the amount of investment is 5 to 9 years, where also the risk is very high. Sir, it emphasizes on prototype operation. Prototype operation, which means not the actual operation, but copy paste similar nature, a smaller scale operation to figure out whether it can work or not, or basically to develop a product. Here was to research to develop the product. Here you start to develop the product and then market it. Sir, then is first round. Develop a product. I hope you realize, for example, my product, and let's say to manufacture a calci, where where it works on AI, where I speak something to the calcium, it gives me answer. I'm solving something, I'm speaking a number, this plus this, it will automatically give the answer. So first is to do the research whether this calcium will work or not. And second, the people in the class, the second thing is doing a prototype operation and developing the product. I need money, because that involves some people, the softwares, the software people, the hardware technician who can develop such calci to me. Sir, first round involves commercial production and marketing money. So ultimately, if the prototype is successful, if the product is developed, then I need to do it at a larger scale. For example, manufacturing 1,000 calcis in a lot. So that commercial production, its marketing is the first round, where the risk is high, 3 to 7 year of investment. Second round, again, the product was initially started. To expand it, the requirement working capital need, because company may not have grown, the company may not have earned sufficient amount, so risk is still high. So this is something you'll have to frankly mug up. I mean, you may know individually each one of them, but which stage has exact, which requirement has an element of remembrance or maybe mugging up? Why do I not use the word mugging up? Because you understand them. Now only the linkage is important, that which stage serves which purpose. That is something you will have to remember, even if I explain it. And not just to you, even I will have to remember it. Perfect. Sir, second stage is to meet the working capital and market expansion requirement. Third round is again for further market expansion and even to a higher level, even acquiring another companies, or maybe developing the product to the next level for a profit making company. The next one may be to come up with more advanced features, coming up with the similar products, expanding to the other geographies, right? Making profit, acquiring other companies. This is third round, which is also called as mezzanine financing, people. The next, everyone, wait, just 1 second. The next, people, is the last round, where the purpose of the last round is bridge financing. The company is already running well. Before it comes to the IPO, which can take 4 months to 5 months or a year, you need money only to sustain for the next 5-6 months or a year. So when the last round happens, the fourth round happens, it is also called as bridge financing, because it is bridging the gap between 2 points. One where I stand in second, where I will have an IPO. Sir, the things frankly, practically can have even 10 rounds. This is just a broad idea of how can the things work. Practically, there can be 10 rounds for financing. Perfect. So that is the states of financing with the activity to be financed. I have explained everything. The point is to remember then if you observe one particular thing. Sir, wherever there are some terminologies like bridge financing, like mezzanine financing, like investment memorandum, or wherever I come across any terminology which you should know particularly, they have been marked in pink. Any terminology, a specific terminology which on which institute may ask a particular question. For example, institute may say that in one of the rounds of financing, right, which facilitates public issue is called as bridge financing. What are other rounds? Institute may not specifically ask the stages of vendor capital financing. It may pick a particular line from any of this and then it say what are the other rounds. So that way you should be able to connect that, okay, I have to specify the rounds with the activity to be financed with the risk level or whatever. The questions previously asked on this has been this, right? Sir, venture capitalist investment process. Through VC, when you do the investing, what is the entire process? Sir, first is deal origination. There are investment bankers who are the intermediaries, or the VC directly will go to the market to figure out what are the deals available, in which startups can they invest. So the startup actually submits an investment memorandum to them. The investment memorandum is the entire plan, right? The business model, the finance plan, the exit plan, like to end-to-end story about the money of the VC. That how will money be acquired, what will they do, how will they make more money, how will they get the exist, the financial projections and everything. This investment memorandum startup submit to the VC and then VC, this is how VC get the deal. Next, what do they do is a screening, right? Screening means then VC will try to, shortlist or select certain companies on various parameters on the basis of data given. The data that you give me, on that basis, I shortlist, for example, 5 companies out of 100 companies that have been received in the form of deals. So then based on the information, I will select the companies and screening will be done, then will be the due diligence. For those 5 companies for which you have given me the data, I will need to do the audit, the due diligence, the verification or the checking of the data that you have given. You said we are the top player in the Indian market. I will go to an external agency like Big Four companies or someone else where there are CAs and MBAs who will do the due diligence to figure out whether the information submitted by them in the investment memorandum in the first step are correct or not. They will be verified the correctness and everything. They say the revenue was this much, was it really this much? That due diligence will happen, then will be the deal structuring. Suppose due diligence happened. Now the deal is to be structured that we give you this money in the form of this security. So deal is a structure such that both the parties win. The valuation of the company arrived is fair, right? The structure of the security is really important. Sometimes convertible structure is bought in to ensure promoter retains right to buy back the share. Sir, sometime it might happen that I'm giving you debt, right? Or sometimes it's like I'm a promoter, I'm starting the company right now, I need money, which is why I'm coming to you to raise the money. But later on it may be possible that I can earn more money somehow, I can get more money somehow. So later on I should have a choice to buy the shares back from you. Back from you means back from the venture capitalist fund, so that I can have more number of shares of the company. Sir, this is something called as tag along clause. You should know about it. There is sometimes when VC give you money, they put a condition. VC says that we are ready to give you money, which means you will say that you are ready to give me money. Me as a promoter, the condition is that promoter must sell a part of his stake along with the VC. Such tag is a tag along clause. Meaning to say, for example, right now I am 40% investor and you are 60% investor in the business, company, I'm promoter, you are a venture capitalist. For example, you sell half of it, so you are left with 30, I am becoming 40 now, which means do you agree I become a majority owner, which is what VC does not want to happen. So VC say when we say 50% of our stake, you also sell 50% of your stake. So we will be left with 20 and 20. That's how the exit will happen. Such a clause where promoter is bound to sell his share proportionately as compared to VC is a tag-along clause as deal structuring, then as post-investment activity. Suppose the money has been taken. I mean, the process is really logical. Whenever there are steps, there is hardly any difficulty to remember them. Do you all people in the class agree to it? There's a process, right? You can't end up writing the due diligence as the first thing. First get the deal, shortlist them, verify it, then give the money. Then after the money has been given, the post investment activity, which means is the startup able to achieve the targets? Is the startup able to give the monthly reports to the VC? There is a pressure on the startups to deliver the results, to achieve the targets. So there are certain guidelines that, like MIS creating the reporting systems, right? Following the budgeting system, corporate governance, transparency, auditing, reviewing, everything is there, sir. Then is exit. Once the post investment activities happen, once the particular valuation has been achieved, whenever the company is ready to go to the public, the exit plan in the form of either you are being sold to the third party, for example, a VC who has invested in the Zomato might find another investor who is now ready to invest in the Zomato. Their shares will be sold to another VC, or maybe it can be by way of IPO, where the uh, exit can happen through public. Another way is to promoter would buy back at a committed pre-agreed price. Promoter at 0 point might commit that later on after 5 years I'll buy this investment at a price from you. That is how the exit plan is. Perfect. Perfect. That is how the venture capitalist process is. Next is, in the eyes of government, there are certain benefits. If you want to achieve those benefits, the benefits are not there in the course. If you want to achieve those benefits, so what is the definition of startup? Institutes Institute has asked this question multiple times. They say, first of all, the business, the entity should be there only for the last 10 years, not more than that. That too in the form of private limited company or limited liability partnership or just the partnership. Second, the turnover should not exceed in any financial year, any of the financial years since the incorporation should not exceed 100 crores. Then the entity should work towards the innovation, development, improvement by the use of technology which can generate employment and wealth, right? This is a subjective point, frankly. Now this is the these are the this is the definition of startup, with the condition that the company should not be created by a restructuring or a splitting of any another big company. For example, TCS, which is already a bigger company, cannot create a separate company, a subsidiary company, or cannot split its division to a new company and say that this is a startup now, it is ready to avail the government benefit. No, this is not allowed. Perfect. Sir, even if there is a support by the government, what are certain reasons that India is a suitable environment for the startups to do business? First, pool of talent. You know our demographic, you know our population's characteristic, right? We are the pool of, greatest pool of youngest generation in the world. So we have a big pool of talent. There are a lot of people passing from the great business schools, great engineering colleges, CAs, who are entering into the business, who are doing their own ventures using their knowledge and skills. Then the cost-effective workforce. We are so many of us that the labor is really cheap in India, meaning to say the production, the setting up, everything can happen at a comparatively lower cost. Workforce is cost-effective, increasing use of internet. Geo, boss, if almost everyone in India has now a 4G or a 5G phone with a good amount of data available every day. So with the excessive use of internet which is available in India, every business seems successful. Affordable telecom services, world's second highest population already there. So startups are leveraging the ease of accessing the stuff in internet. If there won't be internet, there won't be Blinkit. You have to please realize, if there won't be internet, will not be Kite by Zerodha. Perfect, sir. That is the increasing use of internet. Now the technology. The technologies like UPI, other technologies of validating the documents through Aadhaar, OTP, various other technologies making the ease of doing the business. Various process in the business become really quick and simple. The technology For example, you want to do a business which requires some legal validation through Aadhaar. If this technology is there, you can do it. Otherwise, you will send the manual forms to the customers. The customer will sign it. Customer send it back to you. All this technology has become really easy. Right? So development in the software and the hardware system, the data storage and recording system, the artificial investment intelligence, the blockchain technology, the growth in all these sectors have helped the startup. Then the funding options available. Not that the investors in the startups have the market. They also have the funds available to them through various venture capitalists, angel investor, etc., which can easily make the fund available to them. Next is succession planning. Meaning to say, as I say, headings are also important. If you jump directly to the answer, in the exam you will never know what was the heading for which this is the answer. Succession planning. A startup is generally founder driven. I am a founder, I create a company. For example, Amit Gupta create a company. What after he dies? What after something happens to it? What after he resigns? He retires? Sir, that is succession planning. That who will be the next person taking over the business? Sir, risk mitigation. What is the need for succession planning? If something happens to him, when he quits, when he resigns, when something happens, sir, what happens to the company? Risk is a risk which can be mitigated if we plan the succession. That who's the next person who's going to take the company, how will the succession happen? So succession planning is the process of identifying the critical position within the organization, right, and developing an action plan for individual to take the charge of those positions. For example, CEO and CFO are the positions identified. Now let's create a plan that how can individuals in the company or from outside the company can take that position and perform their job with competence. So that is what succession planning is, right? A succession plan identifies future need of people with the skill and potential to perform those leadership roles. What are the skills and potentials they must have? So what is the need? The risk management, right? Then cost removal. Suppose the person is fit and fine, but there is some legal issues where the person is barred from being in the company. Now who's going to run the company? Who's going to take decisions and everything? So that is people in the class cost removal. So in that case also the succession planning helps. Then talent pipeline. It really keeps the employees motivated, because we have seen some example where the employee joined in the company as a particular at a particular post, and then he retires from the company as an MD, because it really keeps the employee motivated. It brings visibility and transparency to the employees on their career path. They know that if you join Big Four today as this associate, then you become senior associate, then maybe the vice president, then maybe the director, then maybe the partner, or whatever is the sequence. Correct? Then conflict resolution mechanism. Sometimes it become a matter of conflict, that who's going to be at that position. So if there is a complete transparency and communication, it become a system of conflict settlement. That this is how we will measure your performance, this is how the person can reach there. So there become more transparency. And last is aligning. The family owned business helps to align the succession planning in the family owned business helps to align the culture, vision and the values of the business. Sir, the business that you do has a culture, has some values, has some vision. So person who's joining here has to be aligned with the company. So if there is a plan in place which prepares individual for that alignment become easy. Aligning that individual for that entire setup become easy. That is the need for succession planning. Then is the strategy. How will you do it? Really simple. 4 simple steps. First of all, evaluate the key position. Identify the key positions, right? That what are the positions, right? Which to evaluate the roles at the critical. The first step is to evaluate the roles that are critical, which has the risk or which has the impact on the business. Such position would bring transformation in the entire business. What are those business positions? Something which can transform my business, like the company CEO, CFO, managing directors, which can impact my business as a whole. You don't have to create it for a particular product manager. That cannot affect your entire company. It may affect only a product, right? We are talking about the positions which are very critical to the company. Sir, then map competencies required for the position. You will have to figure out, identify the skills, the potentials, the qualifications that are needed, the competencies that are needed for that position. So in this step, one need to identify qualification, behavioral and technical competencies required to perform the role, that particular role successfully. Then is identifying in the current workforce. In your current workforce, identify the people which are capable of reaching there once they are nurtured further. Identify what are the possible internal options that can deliver the result that you expect there in step number 2. And if there is a need for training them, developing them, nurturing them, right, that can also be done. We should also place a weight on, if there is a need to search outside of the organization. It may happen that not every time internally someone is available, someone may be hired from outside. That should also be done. And last is bridge leader. Sometimes it does happen that in the family there is a son or there is a daughter or kid is there, perfect, who can take over a managerial position. But that is later, they are not grown enough. So sometimes we hire a leader only to bridge this gap. A father is retiring, in the family the next generation is there to take over that position, but a gap is there, for example maybe of 20 years, because of which they cannot become the manager immediately. Sir, the an outsider as a bridge leader is appointed, who acts to make that young generation, to prepare that generation ready for that leadership role. That's what a bridge leader is. That can be the strategy. Sir, what are the challenges when it comes to succession planning? I want to do that planning, I want to implement it, but what are the challenges? Sir, first of all, a founder mindset can be different from a corporate mindset. When you are a founder, you do the business, you have altogether a different approach than the system. You are a founder because you are not the part of the system. Frankly, you don't like to follow the steps, the process, the system. You want to think independently in your own way. So which is why it become difficult for you know to be able to find those people within the system which can perform that managerial role if they are not the founder. Even if sometimes the startups are matured enough, they have been in a matured stage, then also it becomes difficult to find a person who can fit that company, because the company was created with the founder's mindset, which is difficult elsewhere to find. So the founder's brain is wired differently from the traditional corporate manager. So a corporate managers find it difficult to join such startups, then premature for a startup to implement business strategy. Sometimes it does happen the startup has not grown enough that you can invest time, money, efforts to do this implementation, to identify people, to skill them, to train them. All that become difficult because we have not grown enough, right? So that slows down. If you create such system that slows down the growth of the startup, then as founder is the face of startup. Sometimes it does happen that founder become the face. For example, Lenskart Piyush Bansal become the face. When it comes to Zerodha, Kamath brother become the face. From Paytm, they become the face. For Flipkart, like for Amazon, Jeff Bezos become the face. So, sir, what is a unicorn? Just the last topic. Give me a second. Let me have water. Then we continue. Perfect. Cool. So now you get me, right? A startup which become huge is called as unicorn. So this terminology was first used by Ellen Lee in 2013, right? So a startup company which has achieved a valuation of USD 1 billion is actually a unicorn, right? A startup become unicorn, then the valuation may fall, then it may, you know, get removed with the tag of unicorn. So startup is referred as unicorn. It has the following features. It's a private company being a startup. Sir, it valuation reaches 1 billion. Emphasis on the rarity of success. So frankly saying, it is not, a definition. I mean, this is a fake concept in my opinion in the book of AFM, the CA final AFM study material. Definition of unicorn, that okay, these things are there, then it is a unicorn. No, broad condition is there, 1 billion USD, a startup. But these conditions are, kind of vague, subjective. Features are new idea, disruptive innovation, consumer focus, technology usage, everything is high. If these conditions are met, then it is unicorn, is what the book says. Please remember that you may lose the status of unicorn if the valuation later on falls. In September 11, InMobi, an EdTech startup, became the first unicorn in India when the company, which is SoftBank, a very famous Japanese fund, actually invested in that company, right? And at the time of investment, the valuation of that company was over $1 billion, which is why it became a unicorn. These were 12 topics, people, making it a very comprehensive learning. These were the 12 topics that you should know in the that you should learn in this chapter of startup finance, along with the question being asked in the exam to make your learning really comprehensive. These are the topics which examiner may ask. This is done. Next we do is a startup, then we do financial policy, then we do risk management. Let's go to the securitization now, the second topic to be covered. People. Please tell me, are you all there? Shall we all start with securitization? So at this point, all the people watching up this video, the recorded people especially, if you found the video to be really useful, I would strictly, if you've not liked the video so far, then you won't get the best benefit out of it. People, please comment down in the bottom of this video, how has your experience been so far in this video, so that the video can get a better reach. More students who may be looking out for such marathon can find out, because I believe that in full English language there is no such marathon as of now. So your comments can make the reach of this video really wider. So please do that if you have not done it so far. Yes, perfect. So this video we have especially come up with when a lot of Hindi students were asking for MCQ video, but despite I thought a higher need for this particular video, which is why we have come up with this video. Perfect. And there can be a lot more, frankly. We can have a full English super 150 question video, provided I get that needed motivation to do that, because it will happen only when I see a lot of people, are ready to watch that video. It doesn't sometimes make sense to make that effort for a few students to do it, because that can then personally happen rather than at large level on YouTube. Perfect. So when there are more and more students to get that advantage, it really motivates me. Perfect. So you can play your role by liking this video, commenting down, subscribing the channel, so that I can really come up with such more videos. Perfect. So Pushkarangi, is that your name? So there will be in Hindi a revision video, but not for this attempt. The previous revision video on derivative you can refer, or you can refer to the English video if you understand English. That's the latest video which involves questions and concepts. So those watching up this video, let me tell you, in the description you'll find a playlist. In that playlist has compilation of all chapter, question plus concept, detailed comprehensive revision, right? If you go through that video, you're all set with the concept, you're all set for even question solving through those revision video. The playlist is there. This marathon video is a part of that playlist actually. Cool. So understanding securitization, the next chapter. People in the class, please be there. Before understanding securitization, I would want to take you to my CFA notes, because even in CFA we have this topic of securitization. This broad mechanism, if you understand, you will be able to understand the entire chapter really well. Let's understand the broad mechanism. Sir, let's say there is a bank. Cool. The story you need to understand the chapter, please be there, focus on it. Sir, there's a bank who has an obvious job of giving loan to different people in the market, people like you and me. Cool. So the loan which is given looks like assets, looks like financial assets in the balance sheet of the bank, like the auto loans, the home loans, the business loan, gold loan, credit card loan, personal loan, different kinds of loan given to us. We are the borrowers, also called as obligors, right? The bank is also called as loan originator. Once the bank give loan to us, their amount gets blocked for whatever number of years. For example, if I take a 30-year home loan from a bank, the bank's amount gets blocked. What do I do? Which is why we call the financial assets to be illiquid. Bank would create a company, or it will find a company which already exists in the market called as a special purpose entity, special purpose vehicle. This special purpose vehicle is created specifically to convert these illiquid loans into the liquid cash. But how will that happen? Sir, this SPV will purchase the financial assets from the bank, from the loan originator. But what will it do by purchasing it? Sir, and where will it get money for that? Sir, once it has the loans in its own balance sheet, it will issue some securities to the investor in general, public in general in the market. It will issue the security. What does the security represents? These securities represents people in the class, these loans. They are backed up by these loans. The security gives you the claim or the ownership on these assets which SPV has. When you invest in any particular company, say TCS, what do you get? The ownership on the assets of the company. Similarly, when these people invest in the SPV, they get the ownership on the assets of the SPV, which are nothing but these loans. So once the SPV issue the security at a particular price, they get money, and the same money is used to pay to the bank, to the loan originator. What has happened? The bank has removed these assets from the balance sheet and they have realized cash. The cash can now be used to give further loan to other people in the market. Second, to the SPV. In the asset side, it has these financial assets, and in the liability side, it has this securities issued to the investor. An investor got a place where they can invest in a new type of security. This is the entire system. These securities people are called as sometimes securitized paper. You call them asset backed securities. The securities which are backed by these financial assets. This entire process is called as securitization. Why? Because illiquid financial assets which were there in the balance sheet of the bank are ultimately converted to marketable liquid securities which can be traded. Which means, do you realize the security generated cash, generated liquidity through which the assets could be converted to liquid from the illiquid in nature. This entire process is securitization, correct? If the process is really clear, let's understand the definition. It will now make sense, people. Concept and mechanism of securitization. Securitization process involves creation of pool of assets from illiquid financial assets such as receivables and loans, and their repackaging into marketable securities. Sir, a pool of asset which is there, right? That pool, which means all the assets of different types have been pooled, right? And that pool is then converted or repackaged into the marketable security. That's what the concept of securitization is. These securities are issued to investors. The pool can be automobile loan, credit card receivable, home loan, or any other kind of receivable by the bank. Sir, what are the steps? Creation of pool. The process of securitization begins with creation of pools of asset by originator. Who's the originator? Now you know, the bank, correct? This involves segregating asset backed by similar type of mortgage in terms of interest rate, risk, or maturity. Sir, I have different kind of loans given to different people. Some involves, for example, even if I talk about auto loan, some loans, all of them are backed by automobiles like cars, trucks, or any kind of automobile. Some loans have maturity of 10 year, 5 year, some can have more risk, some can have less risk. So I can segregate the different kinds of loan into different category, like longer maturity, lesser maturity, high risk, low risk, commercial vehicle, passenger vehicle. Similarly, even in the mortgages, commercial property, residential property like the house in which you and me live, right? Similarly, longer maturity, shorter maturity, less risk, more risk. So the segregation of that asset of similar type can happen on the basis of interest rate or risk or maturity. So pooling and then segregating them then involves transferring to SPV. Once those pools have been created, they have been segregated, those bundles can be sold to SPV. So once the assets have been pooled, they are transferred by the originator to SPV, and SPV is an entity especially created for the purpose of securitization, a special purpose vehicle especially created for the purpose of converting those illiquid securities to the illiquid asset to the securities. Sir, sale of securitized paper. SPV designs the instruments, those marketable securities, those asset-backed security based on the interest rate, risk and tenure of pool of the assets. Meaning to say, SPV received the pool of auto loans. Now on auto loans, I know the maturity of auto loan is 5 year. I know the interest at which the loan was given was 10%. So based on what I will receive from these borrowers, I will create a security and commit that interest and maturity on these security. So based on the characteristic of the, I am trying to explain what is being written based on the characteristic of those financial asset. I design the instrument, I decide the characteristic of my security. These instruments can be paid through or passed through. We will talk about it later. And these certificates or securities are issued to the investor against a consideration. I issue the security just like I issue a debenture or a share to you. You give me money. That money is used to pay to the originator. SPV uses that money. Fourth is administration. Suppose assets pooled, sold to SPV, SPV issue the security, all that is fine. Once the money has been received, it has been transferred to the originator, now managing these assets. Because now these are the borrowers, the interest become due, installment become due, notice to be sent to them, they give me money, sometimes they're defaulting, sometimes they're raising concerns, sometimes the interest rate in the market changes. All that job is to be done, people. So the administration of the assets subcontracted back to the originator. The original bank, the originator, does the job of administrating, managing them. It is subcontracted back to it, which collects the principal and interest from the underlying asset, which is transferred it to SPV. The asset, people in the class, you see this. The asset remains with the SPV. The management is done by the originator. They will collect the installment, interest, everything, and they will pass it on to the SPV. Then SPV will figure out how to pass it on to the investor depending upon the type of security we are yet to learn about. Perfect. Fine, sir. Sir, next. Next is recourse to the originator. Performance of securitized paper depends on the performance of the securitized asset unless specified that in case of default, such illiquid asset will go back to the originator. Please look at it. Sir, do you agree? These securities are backed up by these assets. So as an investor, when I look at the security, how will these securities perform depend on how will these assets perform. Meaning to say, if these people pay money, the SPV will pay money to the investor. However, if these people default, then the securities will also default. That simple is the logic. Unless, people in the class listen to me, unless it is specified in the contract that if these people default, the loss will not be borne by these investor. The loss will be borne by the loan originator, which means if they don't pay, then also the originator will have to pay from its pocket to the SPV the amount due so that SPV can pass it on to the investor. If they are the terms, then the risk is not there with the investor. This is called as recourse to the originator. This concept of Approaching the originator in case of default by the borrower or the obliger is called as recourse to originator, repayment of funds. So as I said, if you don't understand the mechanism overall, as I explained here, if you don't understand this terminology of originator, obliger, SPE, investor, these are the securitized paper, securitized asset called as asset-backed securities. If you don't understand these terminologies, these are financial assets, then it become really difficult for you to understand the chapter. Perfect? Cool. Repayment of the fund. SPV will pay the amount in the form of interest and principal to the investor, which are recovered by the originator and passed to SPV. Sir, these people who pay money, to the originator will pass on to the SPV, which will be then paid to the investor. Then is credit rating of instrument. These instruments, these fixed income securities, people which are issued to these investors, are actually credit rated, are given the credit rating by agencies like CRISIL or ICRA, whether the securities have high risk or low risk, and accordingly the investor are able to decide whether we should invest in this security or not. This is the entire mechanism. I hope it is clear. Creating the pool of asset, please summarize it with me. Creating a pool of asset, then transferring it to SPV, then SPV selling it to the investor, papers, then administration, then recourse to the original, then repayment of the fund as the SPV recovers it from the originator, from the obliger through originator, then credit ratings. Perfect. Which are the participants? Institute asks this at various ways. Sometimes it asks for the primary participant, sometimes it asks for the secondary, sometimes it asks somehow else. Perfect. So let us proceed. Sir, three primary participants: originator, the securitizer, one more terminology you got, securitizer for the originator, then the SPV, the middleman, then the investor. So originator, they are the initiator of securitization deal because their amount was blocked in the liquid financial asset. Sir, they sell the financial asset to SPV and receive the fund from the SPV. Sir, they transfer legal and beneficial rights. Sometimes you will observe that a grey text is being written in the theory notes. People, that is just to enhance your understanding. That is written by me to enhance your understanding. That was not there by the institute in the study material. Perfect. So the purpose of initiation is to release the amount blocked in the liquid financial asset. Fine. The SPV, the entity specifically created for this deal to purchase the financial asset and issue the security. So converting the liquid financial asset to marketable security by making an upfront payment to the originator, buying the financial assets from them. Sir, it can be in the form of company or a partnership firm or a trust. Cool. The investor, they are the buyer of those securitized paper. They can be individual or can be the institutional investors, right? Like mutual fund or insurance company. They acquire the securitized paper and receive their money back in the form of principal and interest when the redemption happens. Perfect. The secondary participants, the other people in the process, the obliger, the people who had borrowed, they are the main root of the securitization process. They are the parties who owe the money, who have to pay the money to the originator. They are the assets in the balance sheet of the originator. If you can imagine the originator balance sheet, the loan receivable are the assets, right? The amount due from them is actually transferred to SPV. Sir, the rating agencies. The securities are when issued to the investor, they are rating agencies who figure out the risk of the financial assets. The people from whom the loan is given, what is the risk involved? The people to whom the loans are given, what is the risk involved in that loan? They are the rating agencies. They do paying and receiving agent. They are also called as the servicer or the administrator. Sir, generally the originator is considered, is made the paying and receiving agent. They do the job of receiving the money, sending the notices, sending the reminders. If they don't send anything, taking out the legal procedures and everything, and then sending the money to the SPV. So they are called as servicers, or there may also be some separate entity who does the job of paying and receiving agent called as administrator or servicer. Credit enhancer. Sometimes it does happen that the investors are really finding the securities risky. Then there may be some agency like bank who does the job of credit enhancement. The bank might give the bank guarantee that if these securities, people in the class, if these security defaults, which means if there is a default on the security by the SPV, then as a bank, we give you guarantee that we will make good against that loss. We will pay you the amount of loss. When the bank give you that guarantee, the bank is acting as a credit enhancer. It is enhancing the credit worthiness or the credit rating of these securities. Everyone, the concept is really easy, but sometimes it may look technical to you because the way, because there is a need to learn it in the form of that diagram or imagination that we are doing. If you feel that the video, people in the class, this discussion is helping you out to understand the terminologies or the entire mechanism easily, then now at least this video deserves a comment. Perfect. So credit enhancer, since investor in the security are directly exposed by the performance of the underlying financial asset. The underlying financial asset, those loans that SPV owns, how they perform depends the performance on that depends on that depends the performance of the securities, which is why for additional comfort in the form of credit enhancement, there has to have a credit enhancer who can give the guarantee or something. Sir, a structurer. Sir, to do this entire thing, which means bringing loan originator, give this idea, giving loan originator to this idea of creating SPV, doing the legal formalities, issuing the securities to the investor, getting the credit rating done, bringing the credit enhancement to the picture, organizing this entire thing, bringing the parties together. There is an investment banker who is called as arranger of the deal. This investment banker who brings everyone together, does the transaction happen as a structurer, then the agent or the trustee. Sir, this is off the track to understand, but these investors, actually invest with the help of a trust. This trust and entity is there which represents all the investor, which works for the benefit of the investor, because these individual parties should not be ditched. There should not be any fraud against them. Those entities there who works in the benefit of these investor, right? Who is the point of contact for this SPV? The trust is the point of contact who take care of the investors who acquire the securities. These are the secondary and primary participants. Everyone, are we now set? Moving to the next discussion, which is the features of securitization. Within the entire concept, you will find features, for example, creation of financial instrument. Obviously a feature because it converts illiquid as financial asset into additional financial securities which are backed by those collateral. What is the collateral? The financial assets in the balance sheet of SPV acts as a collateral for the security. When someone issues a security, right, for example, I'm a company issuing a debenture to you, you would find that when you give that money to me, you should have some security, some collateral. So I might give as a company my plant machine to you in the form of collateral, correct? So similarly, I am an SPV issuing a security, you give me money. What is the security for you? What is the collateral for you? Security deposit, I mean to say. Sir, the assets that I have as an SPV, those financial assets are the collateral. Sir, unbundling and bundling. The objective here in this chapter particularly is to simplify the terminology. In the startup finance, the terminologies were really simple out there. The more important thing was to remember them. Here, you'll be able to remember because they are technical, because everything has a meaning, which is why you'll be able to remember them. But explaining the meaning and linking it to the concept is important, which I want to do right now. Sir, bundling and unbundling. When all the assets are combined in one pool, it is bundling. And when these broken down into instruments, it is unbundling. I have given home loan to 10 different people out here, right? I bundle them together. So I have a total bundle of say 1 crore rupee. Then I distribute them at 100 rupee security. So 1 lakh security of 100 each make a total pool of 1 crore for which security can be sold. So unbundling is breaking the amount of 1 crore into different security, but bundling is accumulating, for example, from 10,000 people, right? 1 crore divided by 1 crore divided by 10,000 means I have given, for example, to 1,000 different people a loan of rupee 10,000. So their loan is bundling, accumulating them is bundling, and unbundling is dividing them in securities. Sir, next is tool of risk management. This feature of securitization is from the point of view of originator. Sir, as an originator, when I issue the as an originator, when sell my financial assets to the SPV, do you agree from my balance sheet the risk has been removed? Meaning to say, if it is on a non-recourse basis. Sir, what is this terminology? Let me tell you. As an originator, I have sold my asset to SPV. Now, if this originator defaults, there is two possibility. Either they will bear the risk, or ultimately the investor will bear the risk through SPV. So if it is on a non-recourse basis, meaning to say if these parties default, the loss has to be borne by the investor. Such situation is called as non-recourse basis. In that case, the originator don't have to worry about a loss. If they don't pay you, you don't have to pass it on further. Ultimately, they will bear a loss. They don't pay, you don't pass on. You don't have any risk. Such arrangement is on a non-recourse basis. So as a loan originator, it is a tool of risk management for you. That is what it says. Just one second. That is what it says. In case the assets are securitized on known recourse, the securitization process act as a risk management against the risk of default as it is shifted from originator to the investor. That is the entire point. Perfect. Sir, structured finance. Structured finance means the investor can find different kind of securities structured according to their risk and return requirement. For example, home loans, the bank had given home loan of different types, right? It had 30-year home loan, 5-year home loan, 10-year. So I can create different kind of securities to represent different category of home loan. These are short term, these are medium term, these are long term. So an investor who want to invest only for a shorter period of time will invest here. The investor who want to invest for a medium term time will invest here. Meaning to say the securities are structured to meet the risk and return requirement of different kind of investor. Sir, a security actually is meets the risk and return of different investor, calling it to be the structured instrument. Sir, tranching is basically breaking down those illiquid asset into the securities of different varieties. More risky security, less risky security are two tranches. Sir, longer term maturity, shorter term maturity securities are two different tranches, are basically the categories based on the risk and return which are created from that overall pool which are represented by different securities. Sir, homogeneity. For example, I have created three different tranches. What are the three different tranches? Long term, medium term, short term. These are the tranches I have created. Each tranche will meet risk and return requirement of each type of investor, which is why we call it as structured security, and these are the tranches. Then, sir, what was the next point I was trying to explain? Wait. Homogeneity. Perfect. Within a tranche, if there are 6 investor or say 1,000 investor investing within a tranche, then on the investors will have the homogeneous benefit, which means each security within a tranche will be homogeneous, will be same for all the investor. Like if a particular amount is paid in that category, same amount and homogeneous same amount will be paid to all the investor in that category. That is what this concept is. Under each tranche, the security issued are homogeneous, same in nature. So even a small investor is there who wants to invest, right? For example, you can buy 1 unit of mutual fund or 50,000 units of mutual funds. Both the investor will be treated same. Very similarly, even a small investor who cannot afford big amount can invest because he has a homogeneous rights in the company, in the SPV. So these are the features of securitization. Next is benefit. From the point of view of originator, the benefits are really easy. Their amount which was earlier tied up is now released. Sir, so it is a kind of off balance sheet financing. I had two choices. Please understand. If I want to give loan to more people, I can first raise money from someone. Using that money, I can give loan. Another choice, don't raise more money. Sell these assets, raise money, don't raise new money. Sell this asset, realize money, and then give further loan. So do you agree this process of securitization actually is off balance sheet financing? I am selling off my asset. It is no more there in my balance sheet and then raising money, whereas there is a possibility that related to those assets, the responsibility of serving them, the responsibility related to the risk of default is still belongs to me as originator. This is a off balance sheet financing. People, sir, receivables are securitized. It releases the portion of capital blocked in the asset, resulting in off balance sheet financing, improving liquidity position. Now I could get my liquid assets. Perfect. Next, more specialization in the men business. Sir, once you sell off your assets and suppose you don't have to serve them, do you agree you can do a better or you can focus more on your main business of giving loan and earning money rather than serving the existing people? Serving them by sending reminders for loan repayment, managing their administrative process, KYC process, etc. things you can avoid. Perfect. Sir, that is another thing. Third, helps to improve financial ratio. If you don't sell these assets, what is plan B? Take new loans to give loan. What is the job of bank? Taking deposits in the form of FDs and using that amount to give loan. So for the bank, those FDs are actually loans taken. So when the liability side of the balance sheet in the of the bank increase it affects the financial ratios of the bank, making the bank less interesting for the investors, and in fact sometimes they have to follow RBI regulations. So it helps to improve financial ratio and reduced cost of borrowing. Sir, the bank which has sold the securities basically has to, the bank ultimately has to pay interest, right? When it receives interest, it has to pay interest to the SPV. On a lighter note, try to understand it. Sir, when these security are credit enhanced, which means these investors now feel less risk because they know there is a bank who has given us the guarantee that if the obligers doesn't pay, then the bank will pay. This is the credit guarantee has been received. A credit enhancement has happened. Now the investor find it less risky. Since they are less risky, they are expecting a lesser return. So the bank now knows due to less risk, they have to pay a lesser return to the SPV. So sometimes it happens that they may earn a higher rate of return, but pay to the investors a lower rate of return. So basically they have arranged for finance at a lower cost of interest. That's why they say it's a reduced borrowing cost that they have arranged for money by ultimately paying from a pocket a lower rate of interest as compared to as compared to what they pay when they actually end up borrowing. This is the benefit from originator point of view. From investors point of view, diversification of risk. Rather than investing in the shares or the bonds of the company, I have one more opportunity to invest where I can invest in a particular type of security, home loan security or home loan or the auto loan security or the credit card security. So I have a scope of diversifying my portfolio as an investor. That is what it happens to me. Sir, regulatory requirement. Sometimes it happens that I'm a bank or I'm a mutual fund. There is a regulation that at least this much proportion you should invest in a particular type of security. So for example, this much proportion you should invest in the small enterprises loans, small and medium enterprises loan. So as a mutual fund you become investor and you invest in which securities, which are the business loans given to small and medium sized enterprises. When you purchase in those security, you are indirectly giving loan to the people of to those small and medium sized enterprises, meeting your regulatory requirement. Sir, this is what they mean by regulatory requirement, right? And then protecting against default. Sir, what is the benefit to the investor? So actually, previously we talked about the risk management tool from the perspective of investor, from the perspective of originator, assuming it to be a non-recourse, meaning to say if there is a risk, investor will bear because it is on a non-recourse basis, originator will not bear a risk. However, if it is on a recourse basis, meaning to say if they default, if they don't pay, then originator will have to pay from its pocket and an investor will ultimately receive money. So if it is on a recourse basis, the risk related to default investor will not have to bear. That is a advantage, people. In case of recourse arrangement, if there is any default by the third party, then originator shall make the good the least amount, which means the amount of loss which has happened. These are the benefits of securitization. Then what are the risks involved? Sir, what is this SM 2024? Let me explain. It has come previously also. There are certain topics, people, which are added by the institute in the study material of 2024 when it was revised. Then in 25, nothing was added majorly. I mean, almost nothing was added. Sir, in 2024, new topics, even in the entire AFM, these 4 primary chapters, theory chapters, and even other chapters have been included. All such topics have been marked SM2024 for you to understand that these are the topics which were previously not there but added in May 24 study material. Perfect. So great. Let's learn about the risk. Give me a minute. Give me a minute. Let me have water, please. Perfect. Cool. Credit risk in securitization. When you do this entire thing, what are the different kinds of risk faced by different parties? Credit risk or counterparty risk. Investors are prone to the risk of bankruptcy or non-performance of the servicer. Sir, as an investor here, ultimately we have the money has gone out of our pocket. Ultimately, do you agree? So it has become my risk that if they default, or if the originator is not able to do the servicing of the loan properly, if this company does any fraud, or if the SPV does any fraud, or anything happens to the SPV, then my money is lost. That is the credit risk that investor has. Legal risk. Sir, this entire concept of securitization actually has not been very common in India, right? It's a newly developed concept. So we don't have a very strict laws regarding what all should be done in case of any, you know, in case of any conflict, or in case of any default, what should be the laws? Who's gonna bear it? He should bear it, or he should bear it, or he should bear the risk, or how to recover the amount from them, how to seize their property. Because when they took a home loan or auto loan, these people gave their homes or the cars or the autos in the form of collateral, right? So how to seize their loan? There have been no conclusive laws as of now. Market risk. In general, risk which prevails in the market is there. For example, do you agree? When economy as a whole is turning down, these people who have taken money will also be affected. Their business, their income will affected. Probability of them defaulting increases. If they default, ultimately it is the investor who's gonna bear the risk due to the macro factors. These are the investors. Then factors like industry downturns, etc., affects their ability of the, you know, borrowers to repay the loan. Sir, prepayment risk. What is the risk? You as an investor, invested in a security having a home of security whose collateral is a home loan, right, for 10 years, because home loan security was issued for 10 years. Now imagine these people started to earn well, started to earn well, and they prepaid the entire loan in 2 years on an average. Some paid early, some paid late. So let's say they prepaid the entire loan in 5 years. Do you agree SPV, when received the entire amount, ultimately over the time it will end up paying you, and over a period of 5 years you will get your entire amount back. So you have been prepaid is a prepayment risk. Sir, why is it a risk? Because now you will have to find a newer opportunity to invest, and there is a possibility that earlier you were getting 10% per annum of interest, but in the newer opportunity you may get only say 8%. So that 2% of loss which you might have to bear is the prepayment risk. Perfect. Sir, there is this point here. Combination of prepayment risk and volatile interest rate is the risk faced. With a reduction in the interest rate, prepayment of retail loan increases, resulting in reinvestment risk for the investor. Imagine that rate of interest initially was 10. So they were giving you 10, you were passing on, for example, 10%. The rate in the market has now become 7. In the fixed income securities, you have learned the YTM changes. Do you agree that these people, if they want, can take a new loan at the rate of 7%? Yes. By taking a new loan, they can repay the older loan. They can repay the older loan. So ultimately, investor who was earning 10% will now not be able to earn 10 because the loan has been repaid. So investor will go to the market to make new investment, and the new investment will happen at a newer rate, which in the economy is 7%. You have to understand this. That is what the prepayment risk explained here. So I'm trying to simplify as much as possible this entire thing so that you don't have to mug it up. Someone says, Guruji, Pranam. This is who? Mind guy. What's your name? Everyone. People, interest rate risk. What it means? It means that, sir, from the perspective of SP, you will have to think. I have clarified it here in this text that from whose perspective to think risk. The first two risk, wait. The first two risk was from the perspective of investor. The next risk is from the perspective of SPV. Suppose SPV has committed a risk return of 10% here to the investor. The return that it gets here might be variable. For example, the nature of loan given is a floating rate loan. That LIBOR plus 5% will be the amount of interest that SPV will receive. If the LIBOR in the market increases, SPV receives more, but it has to pay only 10, life is sorted. But if LIBOR falls, the interest that SPV will receive will also fall, but it will have to continue to pay 10, will be a problem to it. Sir, so which is why when fixed versus variable payout issue is there, on the interest that you receive and the interest that you pay, that risk is interest rate risk which SP faces. Perfect. So this mismatch can create a problem. I hope I could explain to you the risk and securitization. The types of two securities: pass-through security, pay-through security. The concept is really simple. The name itself clarifies it actually. Pass-through certificate means, as an SPV, whatever I will receive, I will pass it through. If I receive less interest, I will pass less. If I receive prepayment, I will pass on prepayment. If I don't receive anything due to default, I will not pass it on. Simply passing on what you receive. So all these unit holders are considered to have proportionate claim over the cash flows of the SPV. As a mutual fund holder, as an equity shareholder, do you have a proportionate claim over the assets of the company or the cash flows or the profit of the company? Very similarly, all of you, depending upon the number of securities that you own, you have a proportionate claim in the cash flows, profit, or the assets of the SPV. Whatever is received is passed through in the proportion. So the originator transfers to the SPV entire receipt of cash, which in the form of interest and principal, from the securitized asset. SPV further distributes to the investor. Direct claim: securities have a direct claim of the investor on all the assets that are securitized. Investors carry a proportional right over the assets of the company. Sir, another. Sir, prepayments are also distributed proportionately. That is something you should know. Pay through securities, guys. Pay through securities. What it means? It means that there is a desynchronization. SPE issues the security which does not represent the direct claim of the cash flows. These securities are collateralized by these financial assets. They have a right over the financial assets, but they don't have a direct right as it is over the cash flows. There is a possibility sometimes you receive 8% here, sometimes you receive 7% here, sometimes you receive 6 here. But what you have committed here is a fixed rate of 6.5% to the securities. So there is a desecuritization. Sometimes you receive less, but you have to pay more. Sometimes you receive more, but you have to continue to pay the same fixed amount. Sometimes they default, but you have to continue to pay them. Sometimes you receive extra, so you have to reinvest it somewhere because you can't pay them right now, because what you have committed to them is a different thing with different time interval, and what you will receive is a different thing. Sir, in case of pay through security, right, securities are backed by financial assets of SPV, but that does not have a direct claim as it is over the cash flow. Sir, this structure permits desynchronization of servicing of the security issued from the cash flow generated from the financial assets. Sir, we are desynchronizing the servicing of the security with the cash flows which are received from the financial assets. Sir, it restructure different tranches from varying maturity of receivables. Sir, this structure also permit SPV to reinvest surplus fund to other short-term securities to meet their requirement. Sir, different short tranches. For example, I might receive 10%, but I have created two tranches here. To some people, I will pay 12, to some people, I will pay 9, to some people, I will pay 7. Depending upon the risk involved, I will pay different to different people. So I have desynchronized, I have structured them differently. Second, restructuring different tranches with varying maturity, that is also explained, and the reinvestment also explained, that is pay through security. Strip through security, another less practical existing subject, right? For example, what's your name? Might guy, your ID. Someone said, Guruji, Pranav, what's your name? Your ID is Might guy. Acha, you are watching this video, but you are not at the live point, which is why you're lagging behind. So those who are watching this video but are not at the latest point, your chats I'll be able to see later. Cool. Sir, stripped securities are basically, sir, dividing the securities into two parts. One is interest only security, one is principal only security. When I invest in them, I know that ultimately I will receive cash flows. So there are two types of cash flows I will receive. These people will pay principal as well as these people will pay interest. So there are two different types of security. First security will receive only principal. As an investor, against the first security, I will receive only principal, which is received from the obligors initially. In the second type of security, I will receive only interest, nothing else, right? Which is received by SPV from the obligors primarily. So as an investor, there are two types of securities I can buy. Sir, practically they are less preferred because they have a higher risk. They are volatile in nature. These are the stripped securities. I hope people in the class are able to explain to it pricing of securitized instruments. Sir, when these securities are issued, what are the price at which they will be issued? The language of the institute here is a bit difficult. Sir, first is, from the perspective of investor, it's really easy. Present value of future cash flows. As an investor, when I issue some security, so whatever, so as an investor, when you invest, you will receive some future cash flow. So let's apply the fundamental rule. The present value of future cash flow is the value of any security. So from investor's angle, price can be determined discounting the best estimate of future cash flow using a YTM, yield to maturity of the security of comparable security. So any other security in the market having same risk, similar characteristic become the comparable security. The rate of return on that security become the required rate of return on my security. So using the cash flow at that rate is the pricing. From originator angles, the language is really typical. So I would want you to please consider me not explaining this particular thing and write down in the exam as it is this particular line. From originator's point of view, the instrument can be priced at a rate at which Originator has to incur an outflow, and if that outflow can be amortized over a period of time by investing the amount raised through the security. Sir, this originator, right, although frankly saying it's really difficult to explain this particular thing because the language is really confusing and you will have to write down the language as it is, so you may consider mugging up this particular part frankly. Sir, next is problem faced in securitization. So now I would suggest you to, before we proceed ahead, which I think, so I think we have a lecture of 1 to 1.5 hours left. So let's proceed to take a quick 5-minute break. It is right now 1:13. Let's meet back at 1:20. Then we continue the session. Let's complete the securitization, then the last two topics left, and then financial policy, corporate strategy, and then risk management. All the live people, are we all fine taking a break? Shall we all please meet back at 1:20? A quick 10-minute, 5 to 7-minute break actually. Perfect. I actually feel hungry, so let me have something in quick 5 minutes. Then we all proceed to things, learn the things ahead. Yes, so see you all people after a quick break. Bye. Perfect. People, are you all there? So we were trying to understand what are the problems which are faced while doing the securitization in India. Perfect. Shall we all proceed? The first thing is the stamp duty. People, this process of securitization involves certain things which requires stamp duty charges to be incurred, which are really high. So this process of the steps involve converting from illiquid financial asset to liquid or marketable security involves this additional charge which becomes you know, cost taking part, which makes the investment less lucrative. Then taxation. The rules regarding taxation are not very clear. This is what the Institute AFM book says. Whereas, in my opinion, in DT, you have learnt some clarity on the taxation, like how the income from earned from this asset backed securities are being taxed. They are taxed at SPV level or at the investor level. But according to AFM book, taxation is the another area where we don't have any specific provision regarding the taxation of securitized instruments. Perfect. According to the book, some say SPV is liable to pay the tax. According to book, some say investor is liable to pay the tax. Next is accounting. See, again, this is a newly grown area. So, how exactly the accounting should be done in the books of originator and the books of SPV, right? We don't have a standardized way or the standardized accounting principle for that, which becomes really difficult for the investor to analyze the securities. So accounting and reporting of securitized asset in the books of originator is another concern. In the books of bank, how will you account? I mean, because the illiquid financial assets have been removed from the books, how will you account it? There are no concrete accounting principles for that, although securitization is designated as off balance sheet instrument, but in true sense receivables are removed from originator's balance sheet. You have removed from the balance sheet of the originator. So if they have gone, how is it a way of finance? It is like selling an asset. It is alternative to finance, but it is not a way of finance. Sir, lack of standardization. Since there is no standardization so far, so different SPVs can have their own format of documentation. They have own format of administration. So as an investor, we see that there is no standardization in the market relating to the process of investing, related to the process of administration, which is an obstacle in the growth. Inadequate debt market. If you observe, right, in India as compared to other developed market, the debt market has not grown up really, and especially the debt market, not where from the not in the sense where companies can take the loan from the banks, not that debt market. The debt market means the investor where they can invest in the debt securities. That retail market has not grown. In fact, you would see the share of TCS but not the bond of any other company trading in the market. The debt market has not really grown. Ineffective foreclosure laws. Suppose the obligors has defaulted, the loss which allows the originator to foreclose or seize the property of the of the obliger. There have been ineffective laws for that. What I'm trying to tell you is this particular part where this particular person defaults, is not able to make the payment. Suppose it is a car loan. So originator should ideally have a right to seize the car of the borrower, of the obliger, but there are ineffective laws to do that, which is becoming a reason in the problems or the hindrance of growth in the securitization. Perfect. So since there are 6 points, you will have to write down all 6 of them obviously for a 4-mark question. Correct? So foreclosure laws are not supporting to lending institution. This makes securitization instruments less attractive, because if you're not able to recover the amount from the obliger, as an investor of those securities, ultimately you will have to bear the loss. Correct. Now blockchain. Sir, how come this random topic of blockchain? Actually, the topic is little technical in nature, but if we try to understand it, it will work. Sir, blockchain is what a distributed ledger technology. So what happens is that ledger technology means it is a recording system. What kind of technology? It is a technology which does the job of recording any transaction. So it is a type of system where wherever a transaction happens in the market, it gets recorded, right? And it gets recorded such that it first of all cannot be tempered. Second, its sequence cannot be changed. When you do a transaction, it gets recorded. When someone does the transaction immediately after you, that gets recorded as the next transaction. So chains are recorded such that one cannot modify a particular transaction. Second, they cannot change the sequence of the transaction, right? And since the transaction cannot be altered, it become a reliable source of data recording without any particular authority required to manage the data. It is not a particular authority managing the data. The rather data is managed openly in the market through different participants, right? So it says distributed ledger technology is a shared peer-to-peer decentralized open ledger transaction system. Sir, basically it is a technology where in the market openly the data can be recorded, and since everyone has the data of same type, no one can alter it because your data in that case will not match with everyone else's data in the market, and your data will lose its reliability. So it's a consensus system. Since everyone has the data, only you can alter it. You cannot convince everyone to alter it. So out of, if a data is there at 1 crore places, your data seems altered, your data become unreliable. So that 99,99,999 data points which is there in the market, that continue to prevail. So there is no trusted third party in between. It is a shared peer-to-peer, decentralized, everyone manages it, open ledger accounting system, transaction recording system. This ledger has every entry as permanent, cannot be altered, they are fully irreversible. Any transaction you do to alter the old is recorded as actually a new transaction. So alteration actually is also recorded. Sir, what is the application? In the finance, see, application part, frankly, this is a technology evolving. Similar to how is AI evolving, this technology is evolving. So the exact usage, even institute could not write down. So let's try to simply understand as much as we can on what has institute written down on this. People in the class, blockchain can be used to provide automated trade life cycle in terms of transaction log in any transaction. Suppose there is a share or a vehicle or a real estate property. When they are being traded from one party to another, it has to be recorded the buyer, seller, date of buying, date of selling, amount at which it is bought, sold, the Aadhaar card or the PAN card details, everything. These transactions related to particular assets in the financial service industry can be recorded through this blockchain technology is the first thing. Second, healthcare industry. In the healthcare industry, there are data which is really important, which should not be altered, right? So those data can also be recorded with the help of blockchain technology, right? Although it says a line which is right now we won't be able to understand because we have not entered into the detail of blockchains. It says sharing of data in the healthcare industry by increasing the privacy, security, and interoperability of the data by eliminating interface of the third party. What it says, since there is no single authority to manage it, suppose Apollo hospital chains, right, or Apollo hospitals or Bombay hospital chain, whichever chain, they cannot, they don't have a sole right over the data of any entity. They don't own the data particularly. The data is managed in the market in a decentralized open format. So by not involving that third party, they don't have a right to alter the data. This way we can make the data more secure, at least even in the healthcare industry where the data is sensitive than government related things. Government also need to keep different records like the vehicle registration, the land registration, or data regarding the birth certificate, death certificate, any kind of data which government keeps. That can also be kept through the blockchain technology. It will improve the transparency and provide a better way to monitor and audit the data. Since transparency is there, data is accessible to different authorities, to different permissible parties, right? It can be better audited and monitored. Travel industry, I mean, you have to please understand that this does the job of data recording. So wherever there is a scope of data recording, like healthcare, financial services, travel, government agencies, everywhere that has a scope. Travel industry, blockchain can be applied in money transactions and is storing important documents like passport reservation. Managing travel industry, while traveling, someone might get exchange, like might do the foreign exchange, that is a transaction that happens, plus the parties doing these transactions have passports and other important details. All those details can be stored using the blockchain technology. Even in the travel industry, economic forecast, sometimes related to economy like the GDP, inflation, interest rate, other economic factors are to be forecasted regarding futures. So when that prediction happens at a decentralized level, not by a particular authority, but openly on a larger note by different authorities or different experts in a decentralized format, it makes the data more reliable, right? Making the data more reliable makes the business to plan the future in a better way. So these are the ways in which blockchain can be applied. Now the positives of blockchain become the application, but the negatives become risk, because we say that blockchain has no particular authority, is openly available to different trusted parties. There is a risk that different parties can have different risk tolerance. Perfect. Different parties are exposed to different risk. So different members of a particular blockchain may have different risk tolerance. There may be question about who's responsible for the managed risk. There's no party. If your data is secured with the government, if something happens to the data, government is responsible. If my data is being managed openly, no one is the main authority to do that thing. Who's going to manage the data? Who's going to responsible for that risk is the problem. Second, sir, financial transaction is dependent on the underlying technology. If the underlying consensus mechanism has been tempered, as I said, if there are 1 lakh people, if there are 1 lakh people, one particular person can change the data, right? Not 99 lakhs will change, is the assumption. Imagine that there are, the data is there openly with less number of members. Now if they consensusly, if they collectively agree to temper the data, change the data, then in that case, do you people agree? In that case, the data become tempered, it become unreliable and inaccurate is the problem, right? So positive is the advantage, lack of positivity or negative become the risk. Sir, third, in the absence of central authority, there could be challenge in development and maintenance of process control activity. This entire process of recording and etc., you require some level of control for it, correct? That data should not be leaked, the data should be stored in this format. We might require the systems, the servers and everything for that. Who is going to control the activity? There is no central authority to take this responsibility, right? So user in public, in such case, user of public blockchain find difficult to obtain understanding of IT controls related to IT, related to cyber attacks. What are the controls? That is difficult to understand, sir. It involves humongous data updated frequently. So we should have first of all the servers, softwares and hardwares to handle that data, to monitor that. And it also require that competent people to design and perform that control. There should have capable person in the market who's brilliant enough, the team brilliant enough to monitor and control that data which is getting accumulated every second. Huge amount of data is getting accumulated. You can relate it with the terminology called as big data. Big data. So these are the risks associated. Y'all might find it technical, which I can very well understand because it was technical. The main thing now is this part, that how is securitization related to blockchain or tokenization? So tokenization is basically converting the physical asset into a token. Rather than buying and selling a physical asset, you can buy sell that token which represents your ownership on the token. So it is a process of converting tangible into the blockchain token. Buying selling token will give you the ownership. Digitally representing anything has recently acquired a lot of traction. It can be effective. For example, have you heard uh, buying selling this particular thing? Digital gold, for example. You don't own the gold, it is anywhere lying in someone's back in warehouse, right? Someone's locker security, it is there. You just buy and sell it online digitally. You are buying selling that token because that token represents that particular asset, right? How is it related to the securitization? Really simple, sir. Now, when I say tokenization, it is related to blockchain because when trading of that is recorded through the blockchain, trading of tokenization tokens, when recorded through the blockchain, it involves blockchain technology. And how is it related to the securitization? Do you agree securitization also somewhere involved converting the illiquid asset into the marketable securities? Very similar way. If there is an artwork, if there is a real estate property, if there is a gold, which are all illiquid, distributed at different geographies of India, if they are converted to tokens, they are commonly accessible by all the Indians at a common platform, making it more tradable, giving it more liquidity, which is why they are linked. Sir, since tokenization of illiquid assets attempts to convert them into the liquid, they can be linked, resembles with the process of securitization. Perfect. What it says, people in the class, liquidity. Both create liquidity, which is why they are similar. Diversification. Both help investor to diversify. As an investor, see, this was the benefit from the perspective of asset. That asset become liquid. Now this is the benefit from the perspective of investor, that I have a choice now to diversify. If I want to invest in real estate, buy that token. If you want to invest in commodity artwork, buy that token. Then is trading. Both tradable, helps to generate wealth in the market, right? Line is not absolutely correct, but as the line by institute, we will have to consider it. New opportunity. It gives opportunity to financial institute to come up with the new types of business where they can collect more fees. For example, digital gold is a new product. So Paytm or PhonePe or whichever company does that business, they have a newer way to generate income by collecting some kind of fees when you buy the digital gold. That is how they are similar. People in the class, the entire topic of securitization gets over. I hope I could explain that to you. Moving to the very first chapter, which is financial policy and corporate strategy. Advanced role of CFO. Someone who's a CFO of a company, he has an advanced role. Sir, previously it was only wealth maximization, but after pandemic, the roles have expanded to risk management, overall functioning of the company. Sir, the framework of the entire risk management is to be looked after by the CFO, that at company level, in terms of finance, what are the risks we face and what is the framework to manage that risk. That is what CFO should think. Then supply chain. Supply chains involves right from the procuring the most initial part of my production process till the delivering thing, the last ready-made product to my customer. Sir, the management of that entire supply chain, the financial viability of the supply chain, which depends on the success of my business, has become very critical. It became the role of the CFO. For example, you have everything ready in place, but your manufacturing requires a particular chip. For example, mobile phone manufacturing or the car manufacturing requires a chip which is not available, which is primarily being manufactured in Taiwan, for example. Right? If that chip is not there, the entire car become pointless. What do you do? What do you do? Sir, that supply chain become really important, right? That has been posing the challenge for the company to maintain sustainable growth, which is why financial viability of supply chain has become critical. M&A corporate strategy. As a CFO, for the sake of growth, you should be looking after actively for the targets. By acquiring to them, you can create more value, more wealth, a bigger market share in the company. Since in the recent period, to maintain growth and capture the market share, there has been spate of mergers and acquisition, and the role of CFO has become crucial to take those strategic decisions to identify and merge. Sir, environmental social governance. You know that now there is a requirement for financing which are environmental, social and governance, ESG factor. You have to take care of the environment, you have to take care of society in general, and you have to take care of the transparency, the governance within the company. Sir, so with this concept there has been shift in the role of the CFO from traditional financing to sustainability financing. The details have not been specified. So with this discussion, it can be concluded that CFOs taking a leadership role in the value creation and, you know, that too on a sustainable basis for a longer period of time. Perfect. That was a role of CFO. Sir, strategic financial management meaning at its function. The chapter that you're learning, AFM, right, which has now been like SFM, but which have now been converted to AFM. What is its function? So, very simple function. It applies financial management techniques while taking decisions. What is the purpose? To achieve decision maker's objective. As a decision maker, my objective can be to borrow from someone or raise money at a lower cost, or maybe to invest the money at a higher return. These can be my objectives. So applying the financial management techniques like NPV, IRR, money market hedge versus forward hedge, any kind of technique, while taking the decision of how should I hedge, where should I invest, where should I raise the money from to achieve my objective as a SFM. Perfect. Sir, it is about identification of possible strategies capable of maximizing company's value. Overall, the wealth maximization is objective. So what kind of strategy should we create that the wealth can be maximized? Allocation of scarce capital to the competing opportunities. Sir, allocating the scarce capital, the capital which is the source of finance to me, allocating that to the opportunities which are competing, which are in nature. So it involves financing as well as investing decision. Perfect, people. So, sir, investment and financial decisions. See, this is financing, this is investing, and which is why they say investing and financial decisions involve what? It involves. So, as I said, my objective will be to use institute's language, but not to change it, only explain it. I cannot write and involves financing and investing decision. I will continue to write what institute says, but I will simplify it for you. It involves allocating scarce capital resource to competing project. Hence, investing financing comes into picture. Sir, it involves continual search of best investment opportunity, which is the best project where we can invest. Selection of best profitable opportunity. When you identify different opportunities, you select one particular opportunity or two, three particular opportunities. Determination of optimal mix of fund. When you invest in that opportunity, you need the money. How will you raise it from debt equity? That is the thing. Establishment of system for internal control. Sir, there has to have some internal control for verifying certain things, keeping a monitor, a track over the investment that I've made. So a system for internal control has to be established, and the result for future decision making we need to analyze. Should we continue to make further investment, any kind of future decision making, if I need to make, first I need to analyze the past result for that. Correct? Sir, this is a strategic financial management in its function. So function of a strategic financial management are nothing but the function of investment and financial decision. What are the key decisions falling within the scope of financial strategy? Let me tell you, in this particular chapter, you will observe that most of the headings look similar to each other. So you'll have to be very specific. Advanced role of CFO is altogether a different heading. But a strategic financial management, its function, please try to differentiate it with the scope of financial strategy, the decision in the scope of financial strategy. Perfect. There can be financial decision, investment decision, dividend decision, portfolio decision. Fortunately, all these decisions you have done practically. Financing decision means where to raise the money from and in what proportion. Very simple. Mix of equity, debt and mode of financing. Investment decision is where to invest, which means decision involves profitable and optimal utilization of firm's fund, especially in long-term project. Since future benefits are associated or not known with uncertainty, investment decision necessarily involve risk. Do you agree with the advanced capital budgeting decision chapter, where we tried to incorporate risk by calculating SD and variance of cash flows and NPV? That is what it talks about. Investment decision necessarily involve risk. Therefore, they are evaluated in terms of risk and return both. Remember calculating coefficient of variation in advanced capital budgeting. Fine, sir. Next is dividend decision. It involves decision of how much should be distributed as dividend and how much should be retained with the company. Portfolio decision says in the portfolio management, do you agree? I said once you create a portfolio, don't look at the risk and return at individual security level. Rather, return and risk to be looked at a portfolio level, which is why they say when you are a company, you invest in different portfolios, as in not securities, but the portfolio of capital projects. Capital project A, B, telecom business, this business, that business. So you will have to evaluate your company at a portfolio level, not individual business level. Performance of the entire company rather than the characteristic of individual investment is to be looked at. These are the decisions that you have to take. Are you please understanding it? Next, strategy at different hierarchy levels. At a company, when you go, you have a corporate level strategy, then business level, then functional level. Let me try to explain it here to you. Sir, corporate level strategy means CEO, CFO level strategy. They figure out what business should we do, what business should we not do. Will these business meet my company holistic level objective, the shareholder level objective of achieving wealth, achieving profit, serving to the society, whatever your object was, that was corporate level strategy. Then business level is strategy within the company. When you have multiple business, you think within that business that how can I make this business successful. This is approved by the upper level that this is the business I should do. Now within the business, who are my competitor? How should I succeed? How should I make my product profitable, services more valuable? Below that is the functional level strategy, that in a business there are different functions. Financing is a function, HR is a function, marketing is a function. So how can these different functions be successful? Sir, corporate level, business level, functional level. Corporate level concerned with the selection of business in which company should compete. Should we do this business or not? Creating a right portfolio of such business. It should be able to answer three questions. Suitability. Is the strategy that we create to do the business will work for the common objective of the company? If the objective is wealth maximization, will this strategy work? Feasibility. Number of resources required to formulate and implement the strategy. You feel that the strategy should be implemented, but do I have the sufficient resources quantity to formulate and implement the strategy? You should have sufficient funds to implement this strategy, right? For example, strategies give to the entire India free data and calling network for 6 months by Geo, for example, in the year of 2016, I guess. Correct. So that resources required to formulate and implement the strategy, people, they should be feasible. You should have that resources, then only the strategy is feasible. Acceptability. Will the stakeholders be really satisfied financially and non-financially to relate with the outcome of the strategy? These are the questions one should be able to answer at corporate level strategy. Then this in itself can be a practical question. Please understand this. There may be a 3-mark question that at corporate level strategy, what are the 3 basic questions that should be answered? So 1, 2 and 3, suitability, feasibility, acceptability. Fine. Corporate. Business level strategy is a profit center that is planned independently for other business unit. Telecom is a different business unit which can be planned independently of any other business unit, right? Strategies formed to accomplish objective of SBO are business level strategy. You create a strategy to bring success to that particular business unit as business level strategy. They deal with practical coordination of operating units and developing a competitive advantage of the product and services that you produce. The products and services that you deal with, create the strategy to bring competitive advantage, that is by creating a practical coordination in the operating units, the units which are being operated in the company. Correct? Sir, functional level strategy. Functional level strategy includes strategy at the level of operating departments. So, sir, in the business level strategy, they write a line that you try to bring coordination among different level of strategy. For example, marketing need money, for that the product should get ready, so they relate to operation, for which both of them need money, it relates to financing. So at business level strategy, the coordination among the various operating department will happen. That is what that particular line meant out here. Now Functional level strategy means a strategy at this particular level. They will have objective of meeting the targets, manufacturing the best product with the least cost. They will have a target of reaching as much customer as possible with the least cost. They will have a target of raising money at the least possible source, investing money in the best opportunity, with the best opportunity, raising money with the least possible cost. I wanted to say, I by mistake spoke something else. Anyways, sir, functional level strategy includes strategy at the level of operating departments, right? It involves development and coordination of resource through which business unit strategies can be executed effectively and efficiently. Within the department, if the coordination is really great, then the top is the upper level, the business level strategies can be effectively and efficiently executed. I hope I'm able to explain to you strategy at different levels in the organization. Next is people financial planning and outcome of financial planning. Financial planning is really simple. You have the financial resources, right? Or you want to, you know, maximize the financial resources, you maximize the wealth. For that, you have to make use of financial tools to achieve the financial goals. What it says, financial planning is a system. See, this you don't write in the exam. This is just for you to remember it for your better imaginative memory. Ultimately in the exam you should write text, correct? Financial planning is a systematic approach to maximize existing financial resource. You maximize the available resource by utilizing financial tools. There are tools available to figure out whether to invest, whether to borrow or not. Different tools available, techniques available to achieve the financial goal. What was the financial goal? Right? The For example, wealth creation. If the financial goal, so increase the financial resource available money so that automatically this goal is achieved. For that, using the financial tool is financial planning. Perfect. It is a backbone of business and corporate planning. Obviously, every company primarily created to earn money. So, if the money is well earned, then only the business will succeed, which is why it is a backbone on business planning, corporate planning. Nothing without money can start, right? So any kind of business plan, corporate plan you make, the financial planning comes as a backbone because it will require money. When you do financial planning, what is the outcome? The outcome is really easy. The objective, one second, financial objective will have to be decided, financial decision making will have to be done, and whatever has been achieved should be financially measurable. So financial objective are decided at the very beginning, right? So when you do financial planning, automatically as a result of planning you have the financial objective ready, that what do you want to finally achieve, correct? So rest of the decision can be taken in accordance keeping in mind that objective. Sir, they need to be consistent with the corporate mission and corporate objective. If the corporate objective is to do this, the financial objective should be aligned to the corporate bigger level objective. Fine. Financial decision making. With the help of financial planning, you are able to take financial decision making actually. Cool. So helps in analyzing the financial problems that are being faced by the entity and decide the course of action. Action like, what is the problem? Limited resources the problem. Multiple opportunities to invest, right? This is the problem. So you take decision and the course of action to be taken, like how do you deal with this problem, is the financial decision making. Financial measure is ability to measure the performance using the ratio analysis, financial statement analysis, etc. This topic looks more generic. This topic looks repetition of the things because there actually is repetition and things are common sense based. For chapter 1, see, securitization was technical in nature. Technical things have a beauty. If you understand them once, you start to find them easy because it is technical in nature, it is specific in nature, you are able to remember it, you are able to connect to the dots and everything. This particular chapter is not technical. It is easy, randomly spread. So there are different dots which look similar to each other. For these chapters, you will have to do multiple revisions and automatically you'll be able to connect to it. Perfect. Then interface of financial policy and corporate strategy. How the two things are connected. Very well connected. You create any strategy will require money. So if you require money, won't there has to have a financial plan or policy for that? Correct? So the starting point and end point of the organization is money. The importance of this line will automatically make you people understand how the two things are connected. Interface means connection. For example, the computer screen is an interface between computer and you. So how the two have the interconnection? Sir, the connection between the two has multiple dimensions. In multiple ways they are connected. First is sources of finance and capital structure decision. You want to do any expansion, which is a plan of corporate strategy. You need money, which is a part of financial plan. So when it comes to the source of capital, the two are interrelated. Sir, along with the mobilization, we also decide on the capital structure as a mix of debt and equity. Do you agree? We have already done it. When it comes to the financing decision, the mode of financing and the mix we have done, the mode of financing we mix and we have done. Investment and fund allocation. Sir, the planner, the person who's planning it, must frame policies of regulating investment in fixed and current assets. When you make investment in fixed and current assets, there should have some regulations, that policies for it. Planner should make best possible allocation. There should be the best allocation. I'm not happy with the text of the institute. Topic is how the two are interconnected. This was logical. But how is this interconnected? They, rather than explaining that, went on to some other zone to explain what should a planner do. Investment proposal by different business unit can be proposal to add new product, proposal to increase the level of operation, or to reduce the cost. For example, I have two product, I want to add one more product. I am right now manufacturing 1 lakh unit, I want to manufacture 5 lakh unit, basically a new level. Sir, cost reduction. I am manufacturing everything, but this machine has a higher cost per unit. Bringing a new machine has a lower cost, replacement decision. So these decisions which want relates to corporate strategy, right, automatically involves financial plan. You want to enter into a new business is a corporate strategy, but that requires money, as a financial plan you will have to make. Perfect. Great. Sir, dividend decision. Dividend decision simply decide how much to retain, how much to distribute. So financial policy cannot be worked in isolation of corporate strategy. Financial policy and corporate strategy go hand in hand, are dependent, and attention to corporate strategy makers must be drawn while framing the financial plan, not at a later stage. When you make a financial plan, the corporate policy makers should be brought into the picture, not later, because the two things go hand in hand, because everything needs money is the point. Just by reading the heading, you may not be able to connect what exactly to be written, but at least with this discussion, you'll be able to now connect. Correct the headings. Question heading is fine, but the answer headings are easy. Source of finance and capital structure, investment and fund allocation, dividend policy decision. Cool. Next, sustainable growth rate. The growth rate that the company will be able to sustain for a longer period of time is not a temporary growth rate. Sir, sustainable growth important for a long-term development, right? Suitable financial policy initiative to make sure enterprise growth speed is close to sustainable growth rate. Theoretically, the company can grow at a rate, at a longer time it can grow only at a sustainable growth rate, theoretically. Sir, what is sustainable growth rate? Is the maximum rate of growth in sales that can be achieved given firm's financial asset utilization and the dividend payout and the leverage ratios are fixed, are not constant, are not changing, they are constant. Profitability ratio, net profit margin, gross profit margin. Asset utilization means, sir, asset turnover ratio, fixed asset turnover ratio, dividend payout ratio 30%, 50%, or the debt equity ratios. If all of them remain constant, then what is the maximum growth rate that can be achieved? Do you remember the formula from equity valuation as ROE into the retention ratio? ROE multiplied by the retention ratio is the formula of growth. Now I'll make you people link how ROE and dividend payout ratio fit to this definition. You know the underlying logic of ROE multiplied by the retention ratio. So retention ratio is nothing but 1 minus payout ratio, is which is why payout ratio is used here. Sir, why about the profitability ratio, asset utilization ratio, debt equity mix? The answer for that is in the ROE. So there's something called as DuPont analysis, which is not the part of the curriculum, but we teach it to the CFA students. Please listen to me. ROE actually formula can be broken down into three parts. Asset divided by equity. Asset divided by equity is the formula called as financial leverage ratio, is also called as equity multiplier. Asset sales divided by asset is nothing but asset turnover ratio. You know about it. Net profit divided by sales is the net profit margin. So when you multiply the three ratios, you automatically get ROE. Sir, how come? Asset to asset when gets cancelled, sales to sales when get cancelled, you are left with in net profit divided by equity, which is what the formula for ROE is. In the denominator comes what you invest, in the numerator comes what you receive, what you get in the form of return from that investment. So effectively, when you multiply net profit margin, asset turnover ratio and asset to equity ratio, what you get is ROE. And ROE multiplied by the retention ratio, which is 1 minus dividend payout ratio, give you sustainable growth rate. Which is why in the formula of sustainable growth rate, they say firm's profitability means net profit margin, asset utilization means asset turnover ratio, dividend payout ratio is retention rate, and debt ratio is the asset to equity ratio. Do you agree? If the asset to equity has a ratio, which means, for example, equity is 100, asset is 500, it automatically implies 400 is debt. So indirectly it is telling you about the level of leverage your company has, which is how sustainable growth rate is calculated. And the point is that my company's growth should be close to the sustainable growth rate. Sir, it tells you how much can a firm grow without borrowing more money. Although the line is not 100% correct, the actual line is how much can a company grow without changing the capital structure. Sir, isn't it the same? No. When the company's equity from 100, when it become 200, so debt can also become 50 to 100. So the capital structure ratio of debt to equity can remain from 0.5:1 in both the case. So they are in SGR, you can take additional debt, but only to the extent that your leverage ratios are maintained. You cannot take debt more than 100. But it's not that you cannot take debt at all, it continues to remain 50. No, that's incorrect. Perfect. So that is how the picture is. Cool. Sustainable growth rate. They say if you want to grow beyond this rate, then you should borrow funds from outside source. You need more money, right? Beyond this ratio, beyond the debt ratio of 1:2, beyond this ratio you need money if you want to grow. Beyond that is the sustainable growth rate. Financially sustainable, which organization is considered? People in the class, if you have more sources of income, when you have multiple business, that is the financial sustainable organization. Have more than one way of generating income. For example, when you do business, when you are offline stores and online stores, there are multiple sources of generating income from the same line of business, line of income is second thing. Do strategic action and financial planning. So you have to keep on do financial planning, strategic planning of marketing, growing, beating competitors. What should be the execution for that? Adequate financial system. We should have the financial system in place, verifying the cost, verifying the returns, doing the ratio analysis. Sir, good public image, and have financial decision making independently. Autonomy. Sir, these are the features or things that an organization must have to be financially sustainable. So first, explaining sustainable growth rate, the definition, what the fact that it should be close, my enterprise growth should be close to SGR, the formulas or the variables involved, and the implication that beyond that, if you want to grow, you need to borrow more money, and ultimately the variables, right? Assumption also you'll have to see once at your own. This, and then after sustainable growth rate is the what makes organization financially sustainable. This was people in the class, the entire discussion on this particular chapter. Now moving ahead, people, to the last chapter of this video, which is risk management. Boss, are we all please set? and settled with this? Shall we all proceed ahead to the next and easy and smaller, relatively smaller chapter? Shall we go on to the next chapter? What do you all say? Come on, come on, come on. Sir, types of risk that a business can face is strategic, compilation, operation, financial risk. Not all these questions belong to this particular topic. Maybe some questions in this belong to the types of financial risk which are given below. So this compilation includes all the types of questions. Sir, strategic risk means the risk that see, risk management chapter tells you all the kinds of risk that a business face, investor face, economy face, every kind of risk. Perfect. So please look at this, what it says. A strategic risk means the risk that company strategy might fail. It may not be able to achieve company's goals due to technology, due to competitor, due to customers preference shift. For example, if that AI calculator which I was talking about, I speak the numbers and it gives me the answer, the calci gives me the answer. For example, this there is a change in the customer's preference and this calci is out of the place and the company making this calcis will be out of the business. Yes. So strategic risk, the what happened to Nokia basically? Sir, compliance risk. Different kinds of business have different kinds of compliances. For example, drug companies have different compliances, banks have different, investment companies has compliances by SEBI. The risk that company might not be able to comply, which is why it will have to pay fines, litigations, or maybe it may be barred from doing the business. That is the compliance risk, right? It poses a threat on the survival if it's not able to follow the rules and regulation. Operational risk. There is that company is not able to do the operations well. What happened recently to Indigo, where the lot of flights actually got cancelled and messed up, creating a trouble to the lot of air travelers. That is a risk in which company failed to do the operations properly. It failed to do the processes properly. So it relates to the problem related to process and people. It is a risk related to the internal to the company, might happen to the external factors. For example, the raw material not available, factor is external, but not being able to manufacture is the risk which relates to operation. Perfect. Then financial risk. Risk related to the economy, interest rate, foreign exchange, GDP growth, everything related to the finance which can affect the profitability of the company is the financial risk. These are the four types of risk which are primarily faced by a company. Sir, in financial risk, we have counterparty risk, we have interest rate risk, we have currency risk, we have political risk, we have liquidity risk. And all these risks, people in the class, one by one, all these risks we will have to see one by one. And in that, we will have to see how can we identify them and what are the techniques to manage them. Counterparty risk. Risk of non-honoring of the obligation by the counterparty. We enter into a contract. For example, I say after 3 months I will deliver to you raw material. You give me this payment. If one of the party fail, if I fail to deliver to you raw material, or if you fail to make the payment to me, then both of us are facing this counterparty risk, right? Perfect. Sir, how to identify? Failure to obtain necessary resource to complete the project. I told you that I will deliver to you the goods. First of all, I should have the resource to manufacture it so that I can sell it to you. So failure to obtain the necessary resources. Second, regulatory restriction. Suppose government bars or government imposes ban on import export. Hostile action by foreign government. Suppose foreign government puts a restriction on import or export to a particular country or a particular company for some reason. Sir, let down by the third party despite being capable is not honoring the contract, become insolvent, the other party has become insolvent, not making the payment. These are the hints to identify risk. Perfect. Sir, techniques to manage this risk. What are the techniques to manage? Due diligence before dealing. Before you enter into a deal with third party, have a due diligence of the third party, their financials, their behavior with the other customers, other suppliers. Do not overcommit to a single entity. Don't completely rely on selling goods to a single company or buying from them in a single company, because if the other party has issue, it will ultimately create you the issue. Perfect. Sir, know the exposure limit. How much should you be exposed to different parties? You should know. More capable party, higher level of exposure. Less capable party, lesser level of exposure. Review the limit and procedure for credit approval regularly. It's not that once the party has been given the credit, every time it can be given. Keep on reviewing their capabilities, credit repaying capabilities. So the procedure and the limit should be reviewed. Rapid action in case of likelihood possibility of default. What is the rapid action you can take? Make use of external instrument like bank guarantee, line of credit, risk of default, insurance contract for risk of default. Perfect. So this is counterparty risk, and these are the ways to cover up that counterparty risk. Interest rate risk, it's extremely easy. The risk that rates fluctuate in the market. How do you identify? I mean, is not a very relevant thing from exam point of view to cover, which is why, and you have covered it somehow in the practical portion, you can read it. So techniques to manage this risk, two theoretical, I mean two traditional and three modern. Again, something you've done in IRRM. Asset and liability management. In this approach, the assets and liabilities in the balance sheets are managed such that the income bit, which is the difference between the income received and the income paid, can be interest received and interest paid. The difference between the two interests is my income, that can be maximized. With that mindset, I can manage the risk. Perfect. Sir, FRA, what it says, interest rate future, interest rate option, interest rate swaps. Correct. The meaning of them, you just have to write them down that these are the techniques to manage the risk. Perfect. Sir, great. Next is currency risk. There is that exchange rate can fluctuate unfavorably. How do you manage that risk? Sir, first of all, government. How can you identify the risk? Government action. Government sometimes takes some action which can affect the currency, right? Enter into deal, make some rules, make some laws which can fix the currency, or impose some restriction on the buying of that currency, selling of that currency. So government action can affect the foreign exchange rates, which can ultimately affect my business. Nominal rate of interest, do you know, as per purchasing interest rate parity theorem, doesn't the interest rate between the two countries affect the forward rate? Yes, that is what the point is. Inflation rate, as per purchasing power parity, as you've read in forex, foreign exchange chapter, both of these things. As per purchasing power parity, as you've read in forex, people, isn't it that the inflation affects the, isn't it that the inflation affects the expected spot rate in the economy? Yes, natural calamities like a war-like situation or a flood-like situation, country-level plague like COVID, etc., can impact the exchange rates. War-like situation, so war which happened between, say, Russia, Ukraine, or say Israel, Hamas, can also affect the exchange rates of those countries. Change in government. When the government changes their policy, mindset, approach towards the economy, growth, everything changes which can affect the exchange rate. This is how I identify. How do I manage them? Foreign exchange, the entire chapter, money market hedging, currency option, currency futures, forward hedging, leading, lagging, different types of techniques of currency risk hedging we have done. Political risk, theoretical in nature. On a lighter note, you will have to read at your own. Liquidity risk that organization may not be able to meet its liquidity requirement whenever they become due. For example, imagine that I have 5 lakh rupee debtors, but I have to pay only 3 lakh rupee of creditor. Am I solvent? Obviously, yes, I have to receive 5, pay 3. But 5 lakh will be received after 2 months, 1 lakh is to be paid in 15 days, 3 lakh is to be paid in 15 days. Despite being solvent, can you feel me becoming illiquid? Because the moment when the amount is to be paid, the cash is not available, other assets are in fact available. So liquidity is to be able to have adequate cash whenever needed. The risk that I won't have that liquid cash available is the liquid risk. People in the class. Perfect. Next is evaluation of risk from point of view of different stakeholder. Shareholder point of view, the risk of financial gearing. When I am the equity shareholder, if my company take more debt, it has to pay more interest, less profit is available for me, it is the risk I bear. Because they have the least priority of capital repayment. In case of insolvency, debt preference will be paid first, I'll be paid last. Risk from point of view of lender. Sir, the risk that company having high debt might default in the payment of interest and principal, that is the risk lender is facing. The company itself is facing a risk that if it defaults, it may not be able to repay the debt and debt the amount of interest and principal, in which case company might be forced to go to bankruptcy, to go to liquidation. Perfect. From the government, the risk that if the companies in the economy will become bankrupt, the trust of the public in general, the trust of the investors in the economy will be lost. So society at large, it will lead to distrust. That is the risk that government faces. So even government would want any company to sustain actually. Perfect. Sir, value at risk. The practical question we do at value at risk, but what it is? Sir, it measures the amount of maximum loss that we can have on the investment over a given time period, for example, in 1 day or 5 day or 10 days with a particular confidence level. So I can say that with 99% confidence, I can say that in the next 10 days, the amount of loss will not increase 50,000. Correct? So amount of loss with a particular confidence level, right? How much can be the amount? How much can be the amount of loss with a particular confidence level in a given time period is value at risk. It involves maximum loss, confidence level, time period. It's a statistical method because when it comes to confidence level, we talk about the normal distribution table, which involves Z area and everything. So it's a statistical method, right? Which involves use of standard deviation as well. It has a time horizon, a week or a month during which the loss is talked about. It has a concept of probability, the concept of normal distribution. It has a concept of Z score. That table of Z score actually tells you the probability based on Z score. So first you should have the Z scores, which is measured using standard deviation. Control over risk, it helps you to control the risk. Because once you know the maximum amount of loss, the value which is at risk, you are able to control it. Next is application of value at risk. You calculate it. What is the application? It measures the maximum possible loss. So first VAR measures the applicable maximum loss. Second, it acts as a benchmark of performance measured of any operation or trading. When I do any operation or say trading, I do trading in the stock market. It can be used as a benchmark that your value at risk cannot be more than 10% of the value of investment. It can be used as a benchmark to give to someone that you do trade, you do operation, but value at risk should not be more than 10%. So one is clear that okay, this is the maximum amount of investment I can lose as per the rules. Cool. Fixed limit for individual dealing in the front office as treasury department. Sir, there are departments managing cash who invest in cash, who invest the excessive cash in different money market securities. So that department, the front office, which is that department, it fixes the limit for them, the maximum loss they can bear. It's related to benchmark only to enable management to decide the trading strategies. What kind of strategies that should be chosen, which has the lowest value of risk should be chosen. It acts as a tool to manage my asset and liability, especially in bank. Liabilities are to be paid, assets are to be received. So I should make investment in such assets whose value at risk is manageable because the liabilities are to be paid off from those assets. So these are the applications of value at risk. I would agree that the applications are not really obvious, that just by looking at the name we can imagine, which is why even if you understand certain things, it has an element of remembrance, as I say. Yes. So everyone, this video completes the discussion on 4 important theory chapters. The notes, as I said, is there in the description of this video. Perfect. So that was all from my side. People, anything is there, you may please speak up, else we call it a day. So as I said, if you really like the video, consider liking it. Consider sharing it with your colleagues, juniors, and please put down your genuine feedback in the comment section of this video. Yes. So bye people. See you all. Take care.